Chapter 2. Adverse Selection, a Lemon Market Primer. Welcome back. Last time, we touched upon the fundamental asymmetry of information. Today we delve deeper into one particularly potent consequence of this imbalance: adverse selection. Think of it as a subtle sifting process, where the less desirable elements, the lemons as they're often called, become disproportionately represented in a market. We will explore its implications and how markets attempt to self-correct, focusing particularly on the intriguing strategies of signaling and screening. Imagine a used car market. Potential buyers often lack the expertise to truly assess the mechanical condition of a vehicle. The seller, on the other hand, typically knows far more. This information asymmetry creates fertile ground for adverse selection. Owners of reliable cars, the peaches, may be unwilling to sell at a price that reflects the average quality of all cars, including the lemons. Why accept a lower price that doesn't reflect their car's true value? As a result, the peaches tend to withdraw from the market, leaving a higher proportion of lemons behind. The average quality of cars available declines, buyers become even more wary, and the market can even unravel entirely, a kind of slow economic entropy. This is, of course, a simplification, but the underlying principle permeates numerous aspects of our lives. Think about the insurance market. If an insurer offers a policy at a price reflecting the average risk of the population, it's likely to attract a disproportionate number of high-risk individuals. Those with low risk, the peaches of the insurance world, may find the premium too high relative to their actual risk and choose to forgo insurance altogether. The insurer then faces higher than anticipated claims, forcing them to raise premiums, further exacerbating the adverse selection problem. The system tilts, not towards equilibrium, but towards imbalance. But markets are rarely passive. They possess a remarkable capacity for adaptation, for finding ways to mitigate the effects of information asymmetry. This is where signaling and screening come into play. Signaling refers to actions taken by the informed party, the seller of the car, the healthy individual, to credibly convey their superior quality or lower risk. Education, for example, can be seen as a signal in the job market. By investing time and resources in acquiring a degree, an individual signals their ability, discipline, and willingness to learn. The classical economist might argue that education primarily enhances productivity. However, it also serves as a powerful signal, allowing employers to differentiate between candidates in a world of imperfect information. The very act of obtaining the degree conveys information beyond the acquired knowledge. It whispers of potential. Warranties are another classic example of signaling. A car dealer offering a comprehensive warranty is, in effect, signaling their confidence in the quality of their vehicles. A lemon dealer would be reluctant to offer such a warranty, as the cost of repairs would quickly eat into their profits. The warranty thus acts as a filter, separating the peaches from the lemons. This is a critical point. For a signal to be effective, it must be costly or difficult for the low-quality individuals to mimic. A lemon dealer offering a cheap, easily voided warranty achieves nothing. Screening, on the other hand, refers to actions taken by the uninformed party, the buyer of the car, the insurer, the employer, to elicit information from the informed party. The policymaker might design sophisticated screening mechanisms to reduce adverse selection within governmental programs. Think of insurance companies offering different policy options with varying premiums and deductibles. By observing which options individuals choose, the insurer can infer information about their risk profile. High-risk individuals are more likely to opt for policies with lower deductibles, even if the premiums are higher. The screening process allows the insurer to segment the market and price policies more accurately, reducing the impact of adverse selection. Job interviews, too, are a form of screening. Employers ask questions, conduct tests, and observe candidates' behavior to assess their skills, experience, and personality. They are trying to pierce the veil of imperfect information and identify the peaches who are best suited for the job. The efficacy of these screening mechanisms, of course, varies widely. Some interview techniques are more effective than others in uncovering hidden information. The goal is always the same: to reduce the information asymmetry and make more informed decisions. These strategies are not perfect. Signaling can be costly and inefficient. Screening can be time-consuming and prone to errors. Yet, they represent ingenious attempts to navigate the murky waters of information asymmetry and mitigate the detrimental effects of adverse selection. They bring a modicum of balance to an inherently unbalanced system. As we prepare to conclude, consider this. If signaling and screening are attempts to bridge the information gap, what happens when that gap is not merely a fissure, but a chasm? What happens when one party deliberately manipulates information to their advantage? This leads us to a more insidious economic phenomenon: moral hazard. We'll explore this next time. Until then, moral hazard. Hidden actions and their consequences. Welcome back. If you recall, we previously discussed asymmetric information, the uneven playing field where one party in a transaction possesses more knowledge than the other. We explored how this informational imbalance can disrupt markets, leading to adverse selection, where the bad risks drive out the good. Now, let's turn our attention to another equally pervasive consequence of information asymmetry: moral hazard. Think of it as the shadow that falls after the contract is signed, the potential for one party to alter their behavior in a way that disadvantages the other, knowing their actions are, to some extent, hidden. Imagine, for instance, a homeowner who purchases fire insurance. With the financial burden of a potential fire lessened, might they become slightly less vigilant about checking the wiring or clearing dry leaves from the gutters? This is the essence of moral hazard. The incentive to take on more risk because someone else bears a portion of the cost. It's not necessarily a sign of malice, but rather a rational response to altered incentives. It's a subtle shift, a quiet recalibration of behavior under the umbrella of protection. Now, how do we, as economic actors and policymakers, grapple with this inherent risk? One powerful approach lies in signaling and screening. These are the tools we use to bridge the informational gap, to glean insights into the unseen. Let's consider the role of education in the job market as a prime example of signaling. Why do employers often require a college degree, even for positions that don't directly utilize the specific knowledge gained in those studies? The classical economist might argue that education enhances productivity, and indeed, it often does. But there's another, perhaps more subtle, function at play. Education serves as a signal. It demonstrates to potential employers that the candidate possesses certain desirable traits: intelligence, perseverance, the ability to learn, and the discipline to complete a demanding course of study. These qualities are valuable in virtually any job, regardless of the specific subject matter studied. Think of the student diligently attending classes, completing assignments, and navigating the social complexities of campus life. They are, in effect, sending a signal to future employers, saying, "I am capable, I am committed, and I am worth investing in." The degree itself becomes a shorthand representation of these underlying attributes. It is a costly signal, of course, requiring significant time and effort, but its value lies precisely in that cost. A signal that is too easy to obtain loses its credibility. Similarly, warranties function as signals of product quality. A manufacturer who is confident in the reliability of their product is more likely to offer a generous warranty. Why? Because they anticipate fewer claims, and the warranty becomes a marketing tool, attracting customers who value assurance and peace of mind. A weak or non-existent warranty, conversely, might signal hidden flaws or a lack of confidence in the product's durability. The policymaker will consider the equilibrium. The warranty must be strong enough to be effective, but not so expensive that it prices the product out of the market. Screening, on the other hand, involves actively seeking information to distinguish between different types of individuals or products. Insurance companies, for example, use questionnaires and medical examinations to assess the risk profile of potential clients. They are screening applicants to identify those who are more likely to file claims, allowing them to adjust premiums accordingly. This prevents the good risks from subsidizing the bad risks, maintaining the financial viability of the insurance pool. Think of it as carefully sifting through the sand to find the hidden gems. Job interviews also serve as a screening mechanism. Employers use interviews to assess not only a candidate's skills and experience, but also their personality, communication skills, and overall fit within the company culture. They are attempting to screen out those who might be less productive, less reliable, or less compatible with the team. Signaling and screening, therefore, are essential tools for navigating the complexities of markets with asymmetric information and the ever-present threat of moral hazard. They help us to mitigate risk, improve efficiency, and foster trust in transactions where complete information is elusive. But even with these tools at our disposal, the challenge of information asymmetry remains. Can we ever truly eliminate the potential for hidden actions and their consequences? And what role does reputation play in shaping behavior in a world where information is never perfect? These are questions we will ponder as we move forward into the next phase of our exploration of the economic landscape. Chapter 4. The Origins of Signaling Theory. Spence's education model. Tonight, let us consider a fundamental problem. How do individuals with superior, yet unobservable, qualities convey those qualities to others? Imagine a tranquil lake, still and deep. Beneath the surface lie untold riches, potential that remains hidden from the casual observer. This, in essence, is the situation faced by workers entering the job market. They possess varying levels of skill and productivity, but these qualities are not immediately apparent to employers. The challenge, then, becomes one of revelation. In the middle of the last century, a groundbreaking work emerged that tackled this issue head-on. The work proposed the concept of signaling, the act of voluntarily incurring a cost to credibly transmit information about oneself. We are, of course, talking about the landmark education model that forms the cornerstone of signaling theory. To understand the power of this model, let us consider a stylized world. Imagine a labor market where workers possess either high or low productivity. Employers, however, cannot directly observe this productivity before hiring. They can only rely on imperfect signals, like interviews or past work experience, which may be noisy and unreliable. Now, introduce the possibility of acquiring education. Education, in this context, is not necessarily about gaining specific job skills. Instead, it serves as a signal of underlying ability. Crucially, the cost of acquiring education is assumed to be lower for high productivity workers than for low productivity workers. This difference in cost is the engine that drives the signaling mechanism. Think of it like this: high productivity individuals may find learning easier, or perhaps they are simply more disciplined and better equipped to handle the demands of formal education. Whatever the reason, the relative cost of education creates an opportunity for separation. The key insight of the model is that education can become a credible signal if and only if it is sufficiently costly that low productivity workers find it unprofitable to mimic the behavior of their high productivity counterparts. To achieve this, a separating equilibrium must emerge. A separating equilibrium is a state where high productivity workers choose to acquire a certain level of education, while low productivity workers choose to acquire less or no education. Employers, observing the level of education, can then correctly infer the worker's underlying productivity. The level of education, E, acts as a threshold. Workers who obtain education level E or above are perceived as high productivity and rewarded with higher wages. Those with less education are perceived as low productivity and receive lower wages. This framework has profound implications. It suggests that education can have value not only for its direct contribution to productivity, but also for its signaling function. Even if education does not enhance a worker's skills, it can still lead to higher earnings simply by conveying information to employers. It is important to note that the existence of a separating equilibrium depends on several factors, including the difference in costs between high and low productivity workers, the returns to education, and the beliefs of employers. If education is too cheap, or if employers are too skeptical, the separating equilibrium may unravel. Consider the perspective of the policymaker, wrestling with education funding decisions. This model offers a cautionary tale. Simply throwing money at education may not be enough to improve overall economic performance. It is crucial to understand the signaling role of education and to ensure that it remains a credible and informative signal. And so, the lake reflects the stars, mirroring the complex interplay of information and incentives in the economic landscape. This model provides a powerful lens for understanding how individuals can overcome informational asymmetries and achieve better outcomes. But a question remains: how do institutions, like governments or regulatory bodies, actively screen individuals to differentiate between high and low ability? We shall explore this in our next exploration of economic dynamics. Education as a signal. Separating high and low ability individuals. We've previously explored the asymmetry of information between buyers and sellers, a situation where one party possesses knowledge the other lacks. Now, consider this asymmetry applied to the labor market, a place where firms, the buyers of labor, often struggle to accurately assess the true ability of job applicants, the sellers of their skill. This brings us to the intriguing notion of education as a signal. Think of it as a lighthouse, casting a beam to illuminate the otherwise murky waters of individual capability. Imagine a world where innate abilities are largely invisible. How does a prospective employee communicate their inherent talent and work ethic to a potential employer? The classical economist might argue for direct observation, years of proven performance in similar roles. But for those just entering the workforce or seeking to transition careers, such a history is simply absent. This is where education enters the frame, not necessarily as a direct producer of skills, but as a credible and costly signal of underlying aptitude. To understand this, we must appreciate the subtle distinction between human capital and signaling. Human capital is the stock of knowledge and skills that directly increase productivity. Education, undoubtedly, contributes to human capital. But the signaling aspect argues that education serves as a filter, separating individuals based on traits less easily observed, like intelligence, discipline, and perseverance. The core idea is this: if high-ability individuals find it relatively easier, or less costly, to attain a certain level of education than low-ability individuals, then the act of acquiring that education signals their superior ability to employers. The cost can be monetary, representing tuition and foregone earnings, or psychological, reflecting the effort and dedication required to succeed in a demanding academic environment. Let's consider a simplified model. Suppose there are two types of workers, high ability and low ability. Further assume that employers are willing to pay more to hire high ability workers, but they cannot directly observe who is who. Now, imagine a university degree. Obtaining this degree requires effort, and this effort might be more burdensome for low ability individuals. For instance, perhaps the high-ability individuals grasp concepts more readily, require less study time, and generally find the academic environment less daunting. If the wage premium associated with having a degree is large enough, and the cost of obtaining that degree is sufficiently different between the two groups, then we can reach a separating equilibrium. In this equilibrium, all high-ability individuals will choose to pursue the degree, and all low-ability individuals will choose not to. The degree in this case becomes a valuable signal, allowing employers to confidently distinguish between the two types of workers and offer corresponding wages. This doesn't necessarily mean that the education itself has to be directly relevant to the job. A degree in ancient Greek poetry might still serve as a signal of intelligence and diligence, even if the job is in software engineering. The very fact that the individual successfully navigated the rigors of a challenging academic program speaks volumes about their underlying capabilities. Of course, the reality is far more complex. The policymaker must grapple with the potential for signaling to create inefficiencies. If the primary purpose of education is to signal, rather than to build human capital, we might be overinvesting in education. Resources that could be used more productively elsewhere are instead being poured into an educational system that functions largely as an elaborate sorting mechanism. Furthermore, the signaling model raises questions of fairness and access. If education becomes a prerequisite for upward mobility, but access to quality education is unequally distributed, then the signaling mechanism can perpetuate existing inequalities. Those from privileged backgrounds, with access to better schools and resources, may find it easier to acquire the necessary signals, regardless of their underlying abilities. The signaling model isn't without its critics. Some argue that it downplays the intrinsic value of education, reducing it to a mere instrument for demonstrating pre-existing abilities. Others contend that it fails to adequately account for the role of on-the-job training and experience in shaping worker productivity. Yet, The concept of education as a signal provides a valuable lens through which to understand the complex dynamics of the labor market. It highlights the importance of credible information in mitigating information asymmetry, and it raises important questions about the role of education in promoting both efficiency and equity. As we consider the signals sent by education and how employers attempt to discern true worth, a new question arises. What happens when the signals themselves become corrupted? What countermeasures might be employed to ensure authenticity, and how might these in turn be undermined? Our journey through the landscapes of imperfect information continues. Chapter 6. The assumptions behind the signaling model. Costly signals. Good evening. In our previous discussions, we began to unravel the intricate dance of information asymmetry in markets. We saw how one party, possessing more knowledge than the other, can influence outcomes. Tonight, we delve deeper, focusing on the bedrock upon which the signaling model rests, the concept of costly signals. Think of it as the price of honesty in a world of imperfect information. The core idea is this: for a signal to be credible, it must be costly for individuals who do not possess the characteristic being signaled. If anyone could easily mimic the signal, it would lose its power to differentiate. It's like a finely tuned instrument, only producing music in the hands of a skilled musician. The cost, therefore, acts as a filter, separating the genuine from the counterfeit. Let's consider education, a classic example. The signaling model suggests that a university degree isn't just about acquiring knowledge, although that's certainly a benefit. Crucially, it's about signaling to potential employers that you possess certain desirable traits: intelligence, diligence, perseverance, and the ability to learn. These are qualities employers value, and a degree, particularly from a reputable institution, serves as a costly signal indicating their presence. Why costly? Because obtaining a degree requires significant investment of time, effort, and money. It's not something easily faked. An individual lacking the underlying abilities would find the process far more burdensome, perhaps even prohibitively so. The signal, therefore, becomes a reliable indicator of those sought-after qualities. The classical economist might argue that education's sole purpose should be the transmission of skills, but the signaling model offers a nuanced perspective, recognizing its role as a potent signaling device. Now, let's shift our gaze to warranties. In the market for durable goods, such as cars or appliances, consumers often face uncertainty about the product's quality. A manufacturer could simply claim their product is reliable, but such claims are cheap and easily made. A warranty, on the other hand, represents a more credible signal. Why? Because offering a warranty exposes the manufacturer to potential financial risk. If the product frequently breaks down, the manufacturer will bear the cost of repairs or replacements. Therefore, a company that confidently offers a generous warranty is effectively signaling its belief in the product's durability. It's a form of betting on their own quality. This aligns the manufacturer's incentives with the consumer's interests, fostering trust and encouraging sales. The degree of risk the manufacturer is willing to take is directly correlated to the quality of the product. The same principle applies in job markets. Consider professional certifications or licensing requirements. These often involve rigorous examinations and continuing education, demanding significant effort and commitment. They act as costly signals, indicating a certain level of competence and expertise. They separate those who possess the necessary skills and knowledge from those who don't, giving employers a valuable tool for screening potential candidates. But what happens when the cost of signaling is too high? What if education becomes so expensive that it's only accessible to the wealthy, regardless of their innate abilities? Or if warranty claims are so difficult to process that they discourage legitimate claims, effectively rendering the warranty meaningless? Here, we encounter the potential pitfalls of signaling. The policymaker, in considering the impact of such models, must ensure that the costs associated with signaling are balanced. They should be high enough to deter those who would falsely signal, but not so high as to exclude qualified individuals or undermine the signal's credibility. It's a delicate balancing act, requiring careful consideration of the market dynamics and the potential for unintended consequences. Ultimately, the effectiveness of a signal hinges on its credibility, and credibility is inextricably linked to cost. The more costly a signal is to fake, the more reliable it becomes as a source of information. It's a fundamental principle that underpins much of economic behavior, shaping our understanding of education, warranties, job markets, and countless other aspects of our lives. Think of it as nature's way of maintaining equilibrium in a world perpetually teetering on the edge of information imbalance. As we contemplate these mechanisms, a question lingers, almost a whisper in the economic wind. What are the limits of signaling, and when does it cease to be an effective mechanism for information transmission? We shall explore the nuances of signal jamming in the next chapter. Chapter 7. Equilibrium in Signaling Games. Pooling and Separating Equilibria. Welcome back. As we've gently navigated the landscape of asymmetric information, we've established that knowledge imbalances can profoundly influence market outcomes. Now, we turn our attention to how individuals, knowing they possess private information, might strategically signal that information to others. This brings us to the fascinating concept of equilibrium in signaling games, specifically exploring pooling and separating equilibria. Imagine a tranquil lake. These equilibria represent different states of clarity and distinction within its depths. To understand this, let us revisit our ongoing example of education as a signal in the job market. Individuals differ in their inherent abilities, and employers, lacking direct insight into these abilities, must rely on observable signals. Education then becomes a potential beacon, illuminating the hidden landscape of innate skill. A pooling equilibrium arises when both high ability and low ability individuals choose the same level of education. Picture the lake now, clouded with sediment. The signal, education, provides no differentiation. The employer, observing a certain level of educational attainment, learns nothing new about the applicant's underlying ability. Both types are pooled together. Why might this occur? The cost of education might be prohibitively high for even high-ability individuals to justify the separation. The employer might simply not value education highly enough to offer a sufficient wage premium for higher qualifications, removing the incentive to differentiate. Consider the classical economist, firmly rooted in rational behavior. If the wage offered for any level of education is the average productivity of the pooled group, then high-ability individuals might be discouraged from investing in additional education that doesn't yield a corresponding increase in earnings. This equilibrium, while seemingly efficient on the surface, leads to an underallocation of talent, as high-ability individuals are not appropriately compensated for their potential. Contrast this with a separating equilibrium. In this scenario, high-ability and low-ability individuals choose different levels of education. Our lake becomes clear, the water reflecting the sunlight with pristine accuracy. The signal, education, now perfectly differentiates between the two types. High-ability individuals acquire a level of education that low-ability individuals find too costly to mimic. This difference in cost creates a credible signal. The employer, observing the higher level of education, infers high ability and offers a correspondingly higher wage. However, achieving a separating equilibrium is a delicate balancing act. The cost of signaling must be such that it is worth it for the high-ability individual to invest, but not worth it for the low-ability individual. The policymaker, tasked with fostering efficient markets, must carefully consider policies that influence these costs. Subsidies for education, for instance, could encourage higher levels of attainment. However, if subsidies are too generous, they might disrupt the separating equilibrium, leading back to a pooling scenario where everyone acquires the same level of education, regardless of ability. The existence and stability of these equilibria also depend crucially on the beliefs of the employers. If employers are skeptical of the signal, believing that high levels of education are merely a sign of conformity rather than true ability, then the separating equilibrium may unravel. The lake grows murky again, and the signal loses its potency. Furthermore, the choice between pooling and separating equilibria is not always clear-cut. Hybrid equilibria, where some individuals pool while others separate, can also arise, creating a more complex and nuanced picture of signaling dynamics. These mixed strategies represent a state of near balance within the system, a delicate dance between imitation and distinction. Ultimately, the analysis of signaling games reveals the profound interconnectedness of information, incentives, and outcomes in markets. Understanding these equilibria allows us to appreciate the subtle mechanisms that govern how individuals reveal their private information and how others interpret those signals. As we prepare to move forward, we must ask ourselves, what factors beyond simple cost-benefit analysis might influence an individual's signaling strategy, particularly in contexts where social norms and reputation play a significant role? This question lingers, awaiting our exploration in the chapters to come. Chapter 8. The Role of Government Intervention. Subsidies and regulations. Tonight, we consider the role of government intervention, specifically focusing on subsidies and regulations within the context of signaling and screening, particularly as they relate to education, warranties, and job market. These are areas riddled with information asymmetry, where one party invariably knows more than the other, creating inefficiencies and potential market failures. The question we will address is, how can a benevolent government, armed with imperfect knowledge itself, improve outcomes in these scenarios? Let's begin with education. In a world of perfect information, employers would instantly know the inherent abilities and work ethic of each potential employee. Alas, reality is far more opaque. A college degree, then, becomes a signal. It's a costly investment, undertaken to demonstrate not only acquired knowledge, but also perseverance, intelligence, and the ability to follow through on long-term goals. However, the signal is imperfect. Some may possess the innate abilities without the degree, while others might simply be adept at navigating the academic system without true mastery. Subsidies, in the form of grants and subsidized loans, represent one form of government intervention. The intention is noble: to lower the cost of acquiring this signal, thereby making it accessible to a wider range of individuals. This, theoretically, levels the playing field, allowing those with genuine potential, regardless of their socioeconomic background, to acquire the credentials that will unlock opportunities. However, such subsidies can also distort the signal. If acquiring a degree becomes too easy, its value as a reliable indicator of inherent ability diminishes. We see a dilution effect, where the pool of degree holders becomes less homogeneous, and the signal becomes noisier, requiring employers to engage in more intensive screening processes. Regulations also play a role. Accreditation standards, for instance, are meant to ensure a certain level of quality across educational institutions, strengthening the reliability of the educational signal. However, such regulations can also stifle innovation and create barriers to entry for new, potentially more effective, educational models. There is a delicate balance to be struck between ensuring quality and fostering dynamism. Now, let us turn to warranties. In the market for goods, particularly complex items like automobiles, consumers often lack the expertise to fully assess the product's quality before purchase. Warranties, offered by manufacturers, serve as a signal of confidence in their product. A longer warranty generally implies greater reliability. This is a valuable signal because offering such a warranty is costly. A manufacturer must be prepared to cover the expenses of repairs and replacements. Thus, only manufacturers confident in the durability of their product would be willing to offer a comprehensive warranty. Government intervention here often takes the form of consumer protection laws, mandating minimum warranty standards or requiring clear and transparent disclosure of warranty terms. This aims to protect consumers from deceptive practices and ensure that warranties serve as a credible signal of product quality. However, overly stringent regulations can stifle innovation in warranty design and potentially increase the cost of goods, ultimately harming consumers. Finally, consider the job market. As we've established, employers rely on signals like education and experience to assess potential employees, but these signals are often incomplete and imperfect. Regulations, such as anti-discrimination laws, attempt to ensure fairness in the screening process, preventing employers from using irrelevant or biased criteria to make hiring decisions. Licensing requirements, while intended to ensure competence in certain professions, also act as a form of signaling, assuring consumers that individuals possess a minimum level of skill. However, these regulations also have potential downsides. Overly burdensome licensing requirements can restrict entry into certain professions, limiting competition and potentially increasing prices. Anti-discrimination laws, while crucial for promoting equality, can also create unintended consequences, leading employers to be overly cautious in their hiring decisions. In all these cases, the government acts as a kind of system balancer, attempting to nudge the market towards a more efficient equilibrium. The tools at its disposal, subsidies and regulations, are powerful, but they must be wielded with care. The policymaker must always be mindful of the potential for unintended consequences, the possibility that well-intentioned interventions can distort signals and create new inefficiencies. This is a complex and ongoing challenge, a delicate dance between intervention and laissez-faire. Beyond education, other signals in the job market welcome back. We've spent some time contemplating the role of education as a signal in the vast, often turbulent, waters of the job market. We've considered how a degree, a certification, might serve as a lighthouse, guiding employers to candidates who possess not just knowledge, but also a certain level of diligence, perseverance, and cognitive ability. But the landscape is far more complex than a single lighthouse can illuminate. Education, while powerful, is not the only signal cast upon the waters. Let us now turn our attention to other vital indicators: experience and networks. Experience, in many ways, is the purest signal of all. It is not a proxy for ability. It is ability, demonstrated through direct application. The classical economist, focused on efficiency, might argue that experience is the ultimate test, a real-world trial by fire that separates the truly capable from the merely credentialed. A resume detailing years of relevant work is a testament to problem-solving under pressure, collaboration with colleagues, and the inevitable navigation of unforeseen challenges. Each project completed, each obstacle overcome, adds to the clarity of the signal. It's not just about having done something, but about having learned from it. The quality of the experience, of course, matters immensely. A decade spent stagnating in a dead-end role provides a far weaker signal than, say, 3 years of rapid advancement within a dynamic organization. Consider the medical field. A newly minted doctor, fresh out of residency, possesses a wealth of theoretical knowledge, but it is the years of practical experience, of treating patients with varying conditions and complexities, that truly hone their skills and build confidence. The experienced surgeon's steady hand, the seasoned physician's intuition honed by years of observation, these are not easily replicated in a classroom setting. This accumulated wisdom becomes a potent signal, drawing patients seeking not just competence, but assurance. However, experience alone is not always sufficient. The waters of the job market are often murky, information is imperfect, and asymmetry abounds. This is where the power of networks comes into play. Networks, in their essence, are systems of interconnected individuals who exchange information, provide support, and offer opportunities. A strong network can act as a powerful amplifying signal, boosting the visibility and credibility of an individual's experience. Think of it as a ripple effect. A positive experience with a former colleague, shared within a professional network, can spread rapidly, creating a reputation that precedes the individual. Conversely, a negative experience can similarly reverberate, potentially damaging career prospects. The strength of these connections matters. A recommendation from a respected figure within the industry carries far more weight than a casual endorsement from a distant acquaintance. These networks, therefore, act as both filters and amplifiers, shaping perceptions and influencing hiring decisions. The policymaker, grappling with issues of social mobility, might be particularly concerned about the role of networks. Access to strong, influential networks is often unevenly distributed, favoring those from privileged backgrounds. This can perpetuate existing inequalities, creating a system where opportunities are not based solely on merit or experience, but also on who you know. Efforts to broaden access to networks through mentorship programs, professional associations, and online platforms can help to level the playing field and ensure that talent is not overlooked due to lack of connections. These efforts create a more balanced system, where the signals of merit can shine more brightly. Moreover, networks provide something even experience can't: cultural fit. They offer insights into the unspoken norms, values, and expectations of an organization. A candidate who has been vetted by someone within the network is more likely to seamlessly integrate into the company culture, minimizing the risk of costly mismatches. This cultural alignment becomes a signal of reduced risk for the employer, making them more willing to invest in the candidate. In conclusion, while education serves as an initial signal of potential, experience provides concrete evidence of capability, and networks act as powerful amplifiers and filters, shaping perceptions and influencing opportunity. These three elements, when aligned, create a compelling signal, guiding employers through the complexities of the job market. But there are still other currents, unseen factors that influence this intricate dance of supply and demand. What role does intrinsic motivation play? How do we measure and signal passion and dedication, those qualities that truly set individuals apart? This is the question that will guide our next exploration. The evolution of screening theory. Rothschild and Stiglitz welcome, once more, to our quiet exploration of economic thought. We've previously examined the inherent information asymmetries that plague various markets: a buyer unable to perfectly judge the quality of a used car, an insurer unable to perfectly assess the risk profile of each individual. Building upon those foundations, we now turn to the pivotal work that solidified screening as a powerful analytical tool. Our journey focuses primarily on the groundbreaking contributions of two figures whose names have become practically synonymous with the very concept: the paper by Rothschild and Stiglitz. Before their work, the understanding of how markets reacted to information imbalances was somewhat fragmented. The idea that one party could actively induce another to reveal information through carefully constructed mechanisms was only nascent. Imagine a river, its currents representing the flow of information. Before screening theory, we were only observing the surface currents. The depths, where the riverbed shapes the water's course, remained largely unseen. Screening seeks to illuminate those depths, to understand how hidden characteristics influence observable market behavior. At its core, screening theory posits that the less informed party, say, the employer in a job market, can design contracts or market mechanisms that compel the more informed party, the prospective employee, to self-select into different categories. This self-selection reveals their hidden information. Think of it like a delicate dance, where the steps are strategically choreographed to elicit specific responses. Consider the insurance market, a classic example frequently analyzed through the lens of screening. Insurers face the challenge of adverse selection. Individuals with higher risk are more likely to seek comprehensive insurance coverage. How can an insurer distinguish between high-risk and low-risk individuals when their risk levels are not directly observable? The answer lies in offering a menu of insurance contracts, each with different premiums and deductibles. Low-risk individuals, preferring to avoid higher premiums, might opt for a policy with a higher deductible and lower premium. High-risk individuals, more concerned about potential claims, would likely choose the policy with a lower deductible but a higher premium. Thus, by offering a carefully calibrated set of choices, the insurer can effectively screen individuals based on their underlying risk profiles. This mirrors the process of filtering a solution. Each different filter lets through only the elements with desired qualities. The pivotal contribution of Rothschild and Stiglitz was to rigorously model this self-selection process. Their work elegantly demonstrated how, in the presence of asymmetric information, competitive insurance markets might not exist in a traditional sense. The pooling equilibrium, where everyone is offered the same policy, might unravel as it becomes profitable for an insurer to offer a slightly better deal to the low-risk individuals, leaving the high-risk individuals with a less desirable policy, ultimately causing losses for the insurer initially offering the pooling policy. This is like a precarious balance being disrupted by a small but strategically placed weight. Their analysis showed that only separating equilibria, where different types of individuals choose different contracts, could potentially be stable. Even then, the separating equilibrium might be Pareto inefficient, meaning there's a potential allocation that could make at least one person better off without making anyone else worse off. This inefficiency arises because the less informed party is forced to offer contracts that are specifically designed to deter high-risk individuals from pretending to be low-risk, which introduces distortions into the market. Beyond insurance, the principles of screening extend to numerous other domains. Consider the job market. Employers often use educational attainment as a signal of an individual's ability and work ethic. While education might indeed enhance productivity, it also serves as a screening device. High-ability individuals might be more willing to invest in education because they anticipate higher returns in the labor market. Employers, recognizing this correlation, then use educational credentials as a proxy for ability. This creates an incentive for individuals to acquire education, even if its direct contribution to productivity is limited. Similarly, warranties offered by sellers can serve as a signal of product quality. A manufacturer confident in the durability of its product might be willing to offer a longer warranty, thereby signaling its quality to consumers. The policymaker might create a tax policy that incentivizes self-reporting based on income and investments. In conclusion, the evolution of screening theory, particularly through the seminal work we've discussed, significantly deepened our understanding of how information asymmetries shape market outcomes. It provided a powerful framework for analyzing situations where one party possesses superior information and the other party must design mechanisms to elicit that information. But it also left an important question open. How do signaling mechanisms themselves evolve? Do they become less effective over time as individuals learn to mimic the signals of others? And what role does reputation play in sustaining credible signals? These are questions that beckon us towards the next chapter in our economic exploration. Chapter 11. Insurance Markets and Adverse Selection. Screening Strategies. Good evening. Recall our discussion of adverse selection, the disquieting reality where one party possesses more information than another, leading to potentially disastrous outcomes. In insurance markets, this asymmetry manifests as individuals with higher risks being more likely to seek comprehensive coverage, leaving insurers with a pool skewed towards costly claims. This, in turn, can drive up premiums, pushing out healthier individuals and ultimately destabilizing the market. It's a delicate balance, isn't it? A seesaw of information and risk. Tonight, we explore how insurers attempt to restore equilibrium through screening. Screening, in its essence, is the art of eliciting private information from potential customers to better assess their risk profiles. Unlike signaling, where the informed party proactively reveals information, screening involves the uninformed party designing mechanisms to uncover hidden characteristics. Think of it as carefully sifting through sand to find valuable grains. The insurer designs the sieve, the screening mechanism, and the applicant, through their choices, reveals the composition of the sand, their risk. One common screening strategy involves offering a menu of insurance contracts, each with varying levels of coverage and deductibles. The classical economist, observing this, would immediately recognize the principle of self-selection at play. By strategically designing these contracts, the insurer aims to induce individuals to sort themselves based on their risk levels. For instance, a contract with a high deductible and low premium might attract those with lower perceived risk who are willing to bear a larger out-of-pocket expense in exchange for lower monthly payments. Conversely, a contract with a low deductible and high premium would appeal to those anticipating higher healthcare utilization. Consider, for example, two types of individuals: those prone to accidents and those who are generally careful. Offering only one policy at an average premium would inevitably attract a disproportionate number of accident-prone individuals. However, if the insurer offers two policies, one with a high deductible and a low premium, and another with a low deductible and a high premium, the careful individuals might opt for the high deductible policy, revealing their lower risk aversion. This allows the insurer to better calibrate premiums and avoid the death spiral of adverse selection. Another powerful screening tool is experience rating. This approach leverages past claims history to predict future risk. While seemingly straightforward, it presents its own set of complexities. Individuals with a history of frequent claims might be charged higher premiums, incentivizing them to reduce risky behaviors. However, it can also create a form of lock-in, where individuals are hesitant to switch insurers due to the potential loss of a favorable rating. This can dampen competition and reduce consumer choice. Moreover, the policymaker must grapple with the ethical dimensions of experience rating. Should individuals be penalized for factors beyond their control, such as genetic predispositions to certain illnesses? These are not merely economic questions. They are deeply moral considerations that shape the contours of social welfare. Beyond these direct strategies, insurers also employ indirect screening mechanisms. These can include offering wellness programs or discounts for healthy behaviors. These initiatives not only encourage healthier lifestyles, but also serve as a signal of an individual's commitment to risk mitigation, allowing the insurer to infer lower future claims. However, even the most sophisticated screening mechanisms are not foolproof. Individuals can strategically manipulate their behavior to appear lower risk than they actually are. This constant game of cat and mouse between insurers and the insured underscores the inherent challenges of information asymmetry. Furthermore, the effectiveness of screening strategies depends heavily on the design of the contracts and the characteristics of the population being insured. What works well in one market may prove ineffective in another. As we conclude, consider this. While screening strategies offer a vital defense against adverse selection, they are not a panacea. They require careful design, constant monitoring, and a deep understanding of human behavior. And they lead us to ask, how can policymakers and insurance companies truly measure the risk profile of its customer base? And how often should that risk profile be evaluated? Risk aversion and insurance choices. Signaling and screening. Previously, we considered how individuals, faced with uncertainty, navigate the treacherous waters of risk, often finding solace in the predictable embrace of insurance. But tonight, we turn our attention to a related yet distinct phenomenon: the subtle dance of signaling and screening, where information asymmetry casts long shadows across markets. We'll explore how individuals and institutions attempt to convey hidden qualities and unearth concealed truths, particularly within the realms of education, warranties, and the ever-competitive job market. Consider the pursuit of higher education. Is a university degree simply a repository of knowledge, a direct enhancement of skills? Or does it also serve as a signal, a costly demonstration of inherent abilities, diligence, intelligence, perseverance to prospective employers? The classical economist might argue that education's primary value lies in the skills it imparts. However, the reality is more nuanced. The very act of completing a rigorous academic program, irrespective of the specific subject matter, can communicate valuable information about a candidate's character and aptitude. The student, investing time and resources, is essentially signaling their qualities. Conversely, employers, faced with a pool of applicants and imperfect information, engage in screening. They use educational attainment, along with other observable characteristics, as a filter, an attempt to discern the potentially productive from the less so. They are, in essence, decoding the signals sent by the job seekers. This screening process isn't foolproof, of course. Highly skilled individuals may be overlooked, and less capable individuals may slip through the cracks. But in a world of incomplete information, it represents a rational attempt to mitigate risk. Let us shift our focus to warranties. Why do firms offer warranties on their products? From a purely mechanical perspective, a warranty provides a safety net, a promise to repair or replace a defective item. But it's also a powerful signal of quality. A manufacturer, confident in the reliability of its product, is more likely to offer a generous warranty, thereby signaling its faith to consumers. The consumer, in turn, screens the market, favoring products with robust warranties, recognizing them as a sign of durability and trustworthiness. This is a delicate balance, a feedback loop, where signals and screens constantly adjust to one another. This dynamic interplay is particularly evident in the labor market. Imagine a young professional seeking employment. They meticulously craft their resume, highlighting their accomplishments and skills. This is their signal, a carefully curated presentation of their potential value. The employer, Confronted with a stack of resumes, sifts through them, searching for candidates who appear to possess the desired attributes. This is their screen. The interview process further refines this interaction, allowing both parties to gather more information and adjust their perceptions. Reference checks, skills assessments, and even personality tests are all tools employed in the screening arsenal. The policymaker often grapples with the inefficiencies that arise from these information asymmetries. Regulations requiring standardized product labeling, licensing requirements for certain professions, and anti-discrimination laws are all attempts to level the playing field to ensure that signals are accurate and screens are fair. However, such interventions are not without their own complexities. Overly stringent regulations can stifle innovation and create unintended consequences. The ideal policy strikes a delicate balance, fostering transparency without unduly burdening market participants. These signaling and screening mechanisms are ubiquitous, woven into the fabric of our economic interactions. They represent our imperfect, yet often ingenious, attempts to navigate a world where information is scarce and valuable. But even with the most sophisticated signals and screens, uncertainty remains. Are we truly optimizing our resource allocation, or are we merely chasing shadows in the information maze? This is a question to contemplate as we drift into the night, a prelude to our next exploration into the labyrinthine world of market failures and behavioral economics. Chapter 13. Types of contracts, deductibles, copays, and coverage limits. The landscape of contracts, particularly those in insurance and related fields, is replete with mechanisms aimed at mitigating the problems arising from asymmetric information. Think of it as a delicate dance, where one party holds private information, and the contract itself becomes a tool to elicit that information, or at least, to protect against its worst consequences. The central concept at play here is signaling and screening. Signaling, in essence, is the act of the informed party, let's say, the individual seeking insurance, voluntarily conveying information to the uninformed party, the insurance company. This conveyance must be credible. It must be costly or difficult for someone who doesn't possess that information to mimic. Think of a peacock's tail. It's a signal of fitness precisely because maintaining such elaborate plumage is energetically demanding. The unworthy cannot fake it. In insurance, signals are often imperfect. Direct, transparent revelation of one's risk profile is rarely forthcoming. Instead, we see indirect signals, choices made available by the contract itself that reveal something about the underlying risk. This brings us to our first set of contractual elements: deductibles and copays. A deductible, the amount the insured pays out of pocket before the insurance coverage kicks in, serves as a signal of risk aversion and indirectly of expected claims. Individuals who anticipate needing frequent medical care, those with a higher probability of claiming, will generally prefer lower deductibles. Conversely, those who perceive themselves as low risk are more willing to accept a higher deductible in exchange for a lower premium. The deductible acts as a self-selection mechanism, sorting individuals into risk pools. Copays, a fixed amount the insured pays for each instance of service utilization, operate similarly. They discourage frivolous or unnecessary claims. Someone genuinely needing medical attention will likely be less deterred by a copay than someone seeking a mere precautionary checkup. Again, the copay serves as a signal, revealing the insured's true demand for medical services. However, signaling is only half the story. Screening, on the other hand, is the action taken by the uninformed party, the insurance company in our example, to design contracts that elicit information from the informed party. The insurance company crafts a menu of options, different deductibles, copays, coverage limits, precisely to observe which option individuals choose. This choice reveals information about their risk profile. Coverage limits, the maximum amount the insurance company will pay out for a covered event, represent another key element. High coverage limits attract those who anticipate potentially catastrophic losses. Low coverage limits are more appealing to those whose potential losses are likely to be more modest. The classical economist would argue that the provision of a range of coverage limits allows for a more efficient allocation of resources. tailoring coverage to individual needs and risk profiles. Consider warranties. These are promises made by a seller regarding the quality or performance of a product. They serve as a signal of the seller's confidence in the product. A manufacturer offering a long warranty period is effectively signaling that they believe their product is reliable and unlikely to require repairs. The policymaker, when designing regulations around warranties, must consider the signaling value they provide and the potential for adverse selection, where only sellers of low-quality products offer warranties they don't expect to pay out on. These concepts extend beyond insurance and product warranties. In the job market, education serves as a powerful signal. It's not necessarily that a college degree directly imparts specific job skills, although it certainly can. More importantly, it signals intelligence, perseverance, and the ability to learn and adapt. Employers use education as a screening device, selecting candidates who have demonstrated the capacity to succeed in a demanding academic environment. The effectiveness of these mechanisms, however, is not guaranteed. Information asymmetry persists, and individuals may still be able to strategically manipulate the system. The presence of moral hazard, where insurance coverage encourages riskier behavior, further complicates the landscape. 1. Group insurance and community rating. Addressing adverse selection. Good evening. We've navigated the complexities of individual insurance markets, observing the pitfalls of asymmetric information and the specter of adverse selection. Now, let's consider how we might mitigate these challenges, turning our attention to group insurance and community rating, mechanisms that leverage the power of pooling and shared risk. Our exploration will subtly echo the broader economic themes of signaling and screening, concepts familiar from realms such as education, warranties, and, indeed, the labor market. Imagine, if you will, a still pond. Adverse selection, like an errant pebble, disrupts the tranquil surface, creating ripples of imbalance. The high-risk individuals, knowing their predisposition to illness, are drawn to insurance. This, in turn, drives up premiums, deterring the healthy and creating a spiral. Group insurance seeks to smooth these ripples, fostering a larger, more diverse pool of participants. When insurance is offered to a group, say, employees of a company, the pool inherently includes both high-risk and low-risk individuals. This blending of risk profiles allows insurers to charge premiums that are more representative of the overall group's average risk, rather than being disproportionately influenced by those most likely to file claims. This mechanism subtly mirrors the screening processes used in other markets. Consider the provision of a warranty on a product. By offering a warranty, the manufacturer signals confidence in the product's quality. The warranty, in effect, screens out those who anticipate early failure, attracting customers who perceive the product as reliable. The willingness to offer the warranty is a signal of inherent quality, and it functions as a self-selection mechanism. Community rating extends this principle further. It prohibits insurers from basing premiums on individual health status or pre-existing conditions within a given community. Everyone pays the same rate, regardless of their individual health risks. The policymaker, wrestling with the moral implications of healthcare access, might see community rating as a pathway to greater equity. It ensures that those with pre-existing conditions are not priced out of the market, upholding a principle of social solidarity. However, the classical economist might raise a cautionary flag, noting that community rating, while promoting equity, can potentially exacerbate adverse selection. If healthy individuals are forced to pay the same premium as the less healthy, some may choose to forego insurance, perceiving it as an unfair burden. This exodus of the low risk can, paradoxically, drive up premiums for everyone else, leading to further instability. To counteract this, policymakers often implement measures to encourage broad participation, such as mandates requiring individuals to have health insurance or offering subsidies to make insurance more affordable. These mandates or subsidies act as nudges, gently guiding individuals towards participation, thereby maintaining a balanced risk pool. The parallel to the job market is illuminating. Employers, facing imperfect information about potential employees' abilities, rely on signals such as education and experience. A university degree, for example, serves as a signal of an individual's cognitive abilities, work ethic, and willingness to learn. Employers, in turn, use this signal to screen applicants, identifying those most likely to be productive and successful. Of course, education is not a perfect signal. There are undoubtedly individuals with exceptional talent who lack formal qualifications, and others who possess degrees but lack the practical skills required for a particular job. Nevertheless, education, like group insurance or community rating, provides a valuable mechanism for navigating the inherent uncertainties of the market. Just as a well-designed group insurance plan can mitigate adverse selection by pooling risks, a carefully crafted educational system can help individuals signal their abilities to potential employers. Consider, too, the delicate balancing act required. Overly stringent screening processes in the job market can lead to the exclusion of qualified individuals, while excessively lax screening can result in hiring decisions that are ultimately detrimental to the employer. Similarly, in the insurance market, policies that are too restrictive can leave vulnerable individuals without coverage, while policies that are too lenient can undermine the financial viability of the insurance system. The ideal lies in finding a middle ground, a point of equilibrium that balances the competing goals of equity, efficiency, and sustainability. We must also contemplate the ever-shifting landscape. As medical technology advances and healthcare costs continue to rise, how might these strategies need to adapt to ensure a stable, equitable, and accessible healthcare system for all? That is perhaps a question for another evening, a question that will guide us as we continue our journey through the intricacies of health economics. Chapter 15. Warranties as Signals of Product Quality. A buyer's assurance tonight. Let us consider the humble warranty. You might think of it merely as a piece of paper nestled within the box of a new appliance, but within its carefully worded clauses lies a fascinating interplay of information, trust, and economic signaling. We've previously explored how education functions as a signal in the labor market, separating those with innate abilities and perseverance from those who may lack them. Tonight, we shall see how warranties perform a similar, though distinct, function in the market for goods. Just as a diploma isn't inherently productive, a warranty doesn't magically improve the product it covers. Instead, both act as signals. They communicate something about the underlying characteristics of the individual or the product that might otherwise be difficult for the other party to observe directly. Think of it as an attempt to bridge the information asymmetry that inevitably exists between the seller, who knows intimately the quality of their creation, and the buyer, who can only rely on imperfect cues and past experiences. Imagine a marketplace where goods of varying quality are offered, but consumers cannot readily distinguish between the high-quality and the low-quality items before purchase. This creates a potentially perilous situation. If buyers are unable to discern quality, they might be willing to pay only an average price, reflecting the average quality of goods available. Now, consider what happens to the sellers of truly superior product. Facing a price that doesn't reflect their product's worth, they might be tempted to withdraw from the market altogether. This, in turn, lowers the average quality further, driving the price down again and creating a downward spiral known as adverse selection. The market becomes populated primarily by low-quality goods, a far from ideal outcome. This is where the warranty steps in. It's a promise, a commitment made by the seller to stand behind their product. But crucially, it's not just any promise. It's a credible promise. And credibility is key to the whole system working effectively. Consider the cost structure. A firm that produces shoddy goods will find offering a comprehensive warranty prohibitively expensive. They'll face a flood of claims, eating into their profits. However, a firm that invests in high-quality materials and rigorous quality control can offer a more generous warranty with much less risk. The warranty, therefore, becomes a signal of the firm's confidence in its own product's durability and reliability. The length and scope of the warranty become important signaling devices. A longer warranty suggests greater confidence. A warranty covering a wider range of potential defects implies a more robust product design and manufacturing process. The buyer, observing these warranty terms, can infer information about the underlying product quality that they couldn't have obtained otherwise. Consider the implications for market efficiency. By mitigating the information asymmetry, warranties allow buyers to make more informed decisions. They are willing to pay a premium for products backed by strong warranties because they perceive them to be of higher quality and lower risk. This, in turn, allows the sellers of high-quality goods to command a price that reflects their true value, preventing the adverse selection problem and promoting a more efficient allocation of resources. The classical economist might point out that offering a warranty isn't free. It involves costs, both direct costs associated with handling warranty claims and indirect costs related to monitoring and quality control. The policymaker might also ponder the optimal level of warranty regulation. Is government intervention necessary to ensure that warranties are meaningful and enforceable? Or can the market itself provide sufficient incentives for firms to offer credible warranties? These are important and ongoing debates. The effectiveness of a warranty as a signal hinges on several factors. It must be difficult for low-quality producers to mimic the warranty offered by high-quality producers. There must be a reasonable mechanism for consumers to enforce the warranty. And, crucially, consumers must understand the information conveyed by the warranty terms. If consumers are unable to interpret the warranty correctly, its signaling value diminishes. In essence, the warranty functions as a bridge across the chasm of imperfect information. It allows buyers to see, albeit indirectly, something of the seller's internal assessment of their product. It fosters trust, reduces risk, and ultimately contributes to a more efficient and reliable marketplace. But the story doesn't end here. We've looked at how sellers signal quality. What strategies do buyers use to screen products before making a purchase? What methods of information gathering do they employ to augment, or even circumvent, the need for warranty-based signals? These are the questions that await us in our next exploration. Chapter 16. Types of warranties. Express and implied warranties. Tonight, we continue our exploration of information asymmetry and its subtle dance within the economic landscape. Last time, we considered the power of signaling and screening in the job market, focusing on education as a prime example. A degree, we observed, could serve as a signal of underlying ability or be a tool for firms to screen out those deemed less suitable. Now, we gently shift our focus to another powerful mechanism for mitigating informational imbalances: warranties. Warranties, in their essence, are promises. Promises about the quality, durability, and performance of a product or service. They represent an attempt by the seller to convey information to the buyer, information that the buyer, in the absence of the warranty, might struggle to ascertain. Think of the delicate balance a tightrope walker maintains. Warranties act as a counterbalance, preventing the market from tipping too far into the realm of uncertainty and mistrust. We can broadly categorize warranties into two main types: express and implied. Express warranties are the explicit promises made by the seller. They are the clear and unambiguous statements about the product's capabilities, often found in advertisements, brochures, or written contracts. A car advertisement boasting 100,000-mile powertrain warranty is a prime example of an express warranty. It is a direct, verifiable claim about the product's reliability. This warranty acts as a signal, projecting confidence in the vehicle's longevity. The more extensive the warranty, the stronger the signal, suggesting that the manufacturer has strong faith in their product's enduring quality. Implied warranties, on the other hand, are not explicitly stated. They arise from the inherent nature of the transaction and are imposed by law. These are the unspoken understandings about the product's suitability for its intended purpose. The most common types are the implied warranty of merchantability and the implied warranty of fitness for a particular purpose. The implied warranty of merchantability simply states that the goods sold are fit for the ordinary purpose for which they are used. A toaster, for example, should toast bread. A vacuum cleaner should clean carpets. If the toaster immediately shorts out upon plugging it in, or the vacuum cleaner emits more dust than it collects, the implied warranty of merchantability has been breached. The very act of selling the item implies a baseline level of functionality. It's a quiet reassurance, a whisper of expectation that underlies the transaction. The implied warranty of fitness for a particular purpose is slightly more nuanced. This warranty arises when the buyer relies on the seller's expertise to select a product for a specific need, and the seller knows this. Imagine a hiker consulting with a salesperson about appropriate boots for a challenging trek. If the salesperson recommends a particular pair, knowing the intended use, an implied warranty of fitness for that demanding purpose is created. If the boots fall apart halfway through the hike, despite the salesperson's assurance, this warranty has been violated. Both express and implied warranties serve as crucial tools for combating information asymmetry. They encourage sellers to be more transparent about the quality of their products and provide buyers with recourse in case of defects or failures. This creates a healthier market ecosystem, where trust can blossom and transactions are facilitated with greater confidence. Without these protections, the market could stagnate, choked by uncertainty and fear. Consider the case of a new medical device. A lengthy and comprehensive warranty, covering potential malfunctions and guaranteeing certain performance levels, signals the manufacturer's belief in its efficacy and reliability. This signal is especially crucial in markets where consumers lack the technical expertise to independently assess the product's merits. Similarly, a service provider offering a satisfaction guarantee is signaling confidence in their ability to deliver quality service. It is a commitment to stand behind their work, reducing the perceived risk for the consumer. The effectiveness of warranties as signaling mechanisms, however, is not without its limitations. A warranty is only as good as the company behind it. A fly-by-night operation may offer generous warranties, knowing they will likely disappear before any claims need to be honored. This underscores the importance of reputation and brand credibility in bolstering the signal conveyed by the warranty. A warranty from a reputable company carries far more weight than one from an unknown entity. Warranties, therefore, are not merely legal instruments. They are economic signals, powerful tools that can shape market behavior and influence consumer confidence. They represent a crucial element in the ongoing quest to bridge the information gap between buyers and sellers. But consider this. In an age of planned obsolescence and ever-evolving technology, how do warranties need to adapt to remain effective signals of quality? What new forms of guarantees might emerge to address the anxieties of modern consumers? These are the questions that will guide our exploration next time, as we delve deeper into the dynamic interplay between warranties, trust, and the modern marketplace. The role of reputation. Building trust through warranties. Last time, we explored the concept of adverse selection, the silent thief that undermines market efficiency when information asymmetry reigns. Today, we delve deeper into how economic actors attempt to combat this thief, specifically focusing on the role of warranties as signals of quality and the vital importance of reputation. Think of it as fortifying our economic castle against unseen dangers, building walls of trust brick by brick. Consider the purchase of a used car. The buyer possesses limited information about the vehicle's true condition, while the seller inherently knows more. This informational imbalance creates fertile ground for lemons problems. How can a seller of a truly high-quality used car convince a skeptical buyer of its worth? Here, the concept of signaling becomes crucial. Signaling, in its essence, is the act of conveying information through costly or observable actions. These actions must be more easily undertaken by those with desirable characteristics, in this case, sellers of high-quality cars. A warranty serves as a potent signal. By offering a warranty, the seller is essentially betting on the reliability of their product. If the car is prone to breakdowns, the warranty will cost the seller money in repairs. Thus, only sellers confident in the car's quality are likely to offer generous warranty terms. The warranty acts as a costly signal, separating the wheat from the chaff, the good cars from the lemons. The effectiveness of a warranty as a signal hinges on its credibility. A mere piece of paper promising repairs is insufficient. The warranty must be backed by a reputation for honoring commitments. This is where the concept of reputation enters the frame. A firm, with a strong reputation for standing behind its products, has a vested interest in maintaining that reputation. Damaging it through stingy warranty fulfillment or outright denial would erode consumer trust and ultimately harm future sales. The warranty, therefore, becomes intertwined with the long-term viability of the seller's business. Think of reputation as a slowly accumulating reservoir of goodwill. Each fulfilled promise, each satisfied customer, adds to this reservoir. Each broken promise, each unresolved complaint, drains it away. A large reservoir provides a cushion, allowing the firm to weather occasional setbacks. A depleted reservoir leaves the firm vulnerable to even minor crises. The rational economic actor, cognizant of this dynamic, understands that sacrificing short-term gains through deceptive practices can have devastating long-term consequences. However, the signaling process is not without its imperfections. The presence of moral hazard can complicate matters. A comprehensive warranty might incentivize the buyer to be less careful with the product, knowing that repairs are covered. This, in turn, increases the seller's warranty costs, potentially undermining the profitability of offering such a warranty in the first place. The system, like any complex ecosystem, requires careful balancing to function optimally. The role of the policymaker is to ensure that this system has integrity. Regulations mandating minimum warranty standards in certain industries, for example, can help to alleviate information asymmetry and protect consumers. However, excessive regulation can stifle innovation and create unintended consequences. The optimal level of intervention requires careful consideration of the costs and benefits involved. Furthermore, warranties are not the only way of signaling quality. Branding, advertising, and third-party certifications can also play a role. These signals all contribute to building trust between buyers and sellers, facilitating transactions and promoting economic efficiency. The key is that these signals must be credible and sustainable in the long run. Ultimately, the use of warranties to signal quality and build a positive reputation underscores the fundamental importance of trust in economic relationships. Without trust, transactions become fraught with risk, markets become inefficient, and economic activity suffers. The ability to credibly signal quality is a valuable asset, one that can confer a significant competitive advantage. But is it always the most efficient mechanism? What about industries where reputation is easily transferable, or where barriers to entry are incredibly low? This is a question we will begin to address in our next exploration of market structures. Perhaps, like the flow of a river, the optimal path depends on the landscape. Chapter 18. Extended Warranties. Value Proposition or Profit Center? Good evening. Tonight, let's consider the humble extended warranty, that ubiquitous offering encountered at the point of purchase. We've touched upon the challenges created by asymmetric information, situations where one party possesses more knowledge than the other. The marketplace, forever seeking equilibrium, develops mechanisms to navigate these informational imbalances. Education, as we've seen, serves as a signal of inherent ability. Warranties, on the other hand, function more as a screen, separating high-quality goods from potentially problematic ones. Consider the extended warranty from the manufacturer's perspective. Why offer it? The classical economist, ever focused on rational self-interest, might suggest a rather cynical view. The warranty, they would argue, is primarily a profit center. If the product is inherently reliable, the cost of claims will be low, and the premium paid for the warranty becomes pure profit. The firm is essentially betting against the customer, capitalizing on their risk aversion. This view emphasizes the potential for moral hazard. The knowledge that a product is insured might lead consumers to be less careful in their usage, further boosting warranty claims, and thereby boosting profit. But let's complicate this picture. The thoughtful producer understands that reputation matters. A flood of warranty claims, even if profitable in the short term, can erode brand loyalty and diminish future sales. This producer might view the extended warranty as a form of signaling. By offering a comprehensive warranty, they're signaling confidence in the quality and durability of their product. The signal is only credible if the underlying product is, in fact, reliable. If the failure rate is high, the warranty becomes a costly burden, undermining the very purpose of offering it. The warranty cost is the signal, in other words. This brings us to the consumer's perspective. Why purchase an extended warranty? The obvious answer is risk aversion. The consumer fears the financial burden of unexpected repairs, especially for high-value items like electronics or appliances. But the decision is rarely straightforward. The consumer is operating under conditions of incomplete information. They don't know the true reliability of the product, and they might overestimate the likelihood of failure, succumbing to availability bias, where vivid examples of product malfunctions loom large in their minds. Furthermore, the econometrician could perform a regression analysis. Perhaps certain demographics are more likely to purchase extended warranties than others. Are these groups inherently more risk-averse, or are they simply less informed about the true reliability of the product? Perhaps they are more persuaded by marketing tactics, or perceive a greater financial risk due to their limited income. The policymaker, observing this complex interplay, might consider the role of regulation. Should warranties be standardized to make them easier to understand? Should manufacturers be required to disclose historical failure rates? These interventions aim to reduce information asymmetry and empower consumers to make more informed decisions. However, heavy-handed regulation can stifle innovation and limit consumer choice. The challenge lies in finding the right balance, in calibrating the system to promote both consumer protection and market efficiency. The extended warranty market, therefore, is a microcosm of the broader challenges posed by information asymmetry. It's a delicate dance between signaling and screening, between profit maximization and reputation management, between consumer fears and manufacturer assurances. The success of the extended warranty hinges on its ability to bridge the informational gap and create value for both parties. If it merely becomes a vehicle for exploiting consumer anxieties, it risks undermining the very foundations of trust upon which the market economy rests. History of higher education. From elite institutions to mass access, we've explored the foundational concepts of human capital, the skills and knowledge we acquire that enhance our productive capabilities. Now, let's turn our attention to higher education, that formalized crucible where such human capital is ostensibly forged. But is education only about forging skills? Or is something else at play, something more signaling? Consider the ivory towers of old, those bastions of knowledge populated by a select few. Originally, higher education served primarily as a marker of status, a signal of inherited wealth and social standing. The curriculum, often steeped in classical literature and philosophy, wasn't necessarily directly applicable to practical trades. Its value lay in its exclusivity, a demonstration that one possessed the leisure and means to pursue purely intellectual pursuits. The university, in this era, was less a training ground and more a social filter. As societies evolved, the demands placed upon them shifted. Industrialization and technological advancement created a need for specialized knowledge. Universities began to adapt, incorporating scientific disciplines and engineering programs. Yet, the signaling function persisted. Even with the introduction of practical skills, the mere act of graduating from a prestigious institution continued to convey valuable information to potential employers. This brings us to the concept of signaling and screening in the context of education. Imagine a job market as a vast pool of potential candidates, each with varying levels of ability and motivation. However, these qualities are often difficult to discern directly. The employer, facing uncertainty, seeks reliable signals that can differentiate applicants. A university degree, particularly from a reputable institution, serves precisely this purpose. It's a costly signal, representing years of effort, dedication, and intellectual capability. The classical economist might argue this signal, regardless of the specific subject studied, reduces the employer's search costs. The degree acts as a screen, filtering out those deemed less likely to possess the desired qualities. Think of it like a warranty on a product. A manufacturer confident in their product's quality will offer a robust warranty, signaling their belief in its durability. Similarly, a student willing to invest time and resources in a demanding academic program signals their confidence in their own abilities and work ethic. The degree is, in essence, a warranty on the graduate's potential. But what happens when access to higher education expands? As universities transition from elite institutions to models of mass access, the signaling value of a degree can be diluted. When a larger proportion of the population possesses a university education, the signal becomes less exclusive. The policymaker might then face the challenge of maintaining the quality and rigor of academic programs to preserve their signaling value. This has led to the rise of alternative credentials, such as specialized certifications and online microcourses. These shorter, more focused programs offer a different type of signal, one that emphasizes specific skills and competencies. They represent a potential shift away from the traditional, broad-based university degree towards a more targeted and modular approach to human capital development. This new system, however, presents its own challenges. How can we ensure the quality and credibility of these alternative credentials? How do we prevent the market from being flooded with meaningless certifications? The history of higher education, viewed through the lens of signaling and screening, reveals a dynamic interplay between the pursuit of knowledge and the communication of value. It's a story of adaptation, of institutions evolving to meet the changing needs of society and the demands of the job market. But what happens when the very nature of work itself undergoes a radical transformation, driven by automation and artificial intelligence? Will the signals of today remain relevant in the economies of tomorrow? A question, perhaps, for our next consideration. The changing landscape of the job market, skill demands, and technological advancements. Good evening. Tonight, we delve into the evolving terrain of the job market, a landscape sculpted by the relentless winds of technological advancement and shifting skill requirements. Our guiding concept is that of signaling and screening, a lens through which we can better understand how employers and potential employees navigate the murky waters of imperfect information. Think of it as a delicate dance of revelation and assessment, a continuous calibration in a world where inherent uncertainty reigns. At its heart, signaling refers to actions taken by individuals, in this case, job seekers, to convey information about their abilities and qualification. It's the carefully crafted resume, the practiced interview response, the advanced degree proudly displayed. Education, in this context, becomes a powerful signal. It's not merely about the accumulation of knowledge, although that is certainly important. It's also about demonstrating the capacity for sustained effort, the ability to learn, and the adherence to standards, qualities highly valued by employers. The sheepskin, the diploma, serves as a tangible representation of these less tangible virtues. Now, the classical economist might argue that the intrinsic value of education lies solely in its ability to enhance productivity. If education directly translates to increased output, then the higher wages earned by the educated simply reflect their greater contribution. However, signaling theory posits a more nuanced perspective. Even if education doesn't directly enhance productivity to the extent suggested by the wage premium, it can still be economically rational. It acts as a filter, separating individuals with certain desirable traits from those without. The very act of completing a demanding course of study signals dedication and cognitive ability, even if the specific content learned isn't directly applicable to the job at hand. This leads us to screening, the reciprocal process employed by employers to discern the true capabilities of potential hires. Faced with a sea of applicants, each presenting themselves in the most favorable light, employers need effective mechanisms to separate the wheat from the chaff. Interviews, aptitude tests, and probationary periods are all forms of screening. They are designed to elicit further information, to validate or invalidate the signals emitted by job seekers. Warranties, often associated with product quality, can also be applied metaphorically to the job market. A probationary period, for example, acts as a kind of warranty, a short-term guarantee that the employee possesses the skills and attributes advertised. If the employee fails to perform adequately during this trial period, the employer can terminate the employment relationship with minimal cost. The rise of technological advancements further complicates this signaling and screening game. As industries evolve, the demand for specific skills shifts, often rapidly. Traditional educational credentials may become less relevant, while new forms of signaling, such as online certifications and open-source contributions, gain prominence. The policymaker faces a significant challenge in ensuring that educational systems adapt quickly enough to meet these changing needs. This necessitates a greater emphasis on lifelong learning, and the development of adaptable skills, the ability to learn new technologies and processes on demand. Consider the burgeoning field of artificial intelligence. A traditional computer science degree, while valuable, may not be sufficient to demonstrate expertise in specific AI techniques. Instead, employers might place greater weight on demonstrated experience with machine learning frameworks or contributions to AI research projects. This shift requires job seekers to proactively signal their skills through practical application and continuous learning. Moreover, technological advancements can also enhance the screening process. Automated resume screening tools can quickly filter applicants based on keywords and qualifications. AI-powered interview platforms can assess candidates' communication skills and personality traits. While these technologies offer efficiency gains, they also raise ethical concerns about bias and fairness. It is crucial to ensure that these tools are used responsibly and do not perpetuate existing inequalities in the labor market. The delicate balance between signaling and screening is constantly being renegotiated. The ever-accelerating pace of technological change demands a more dynamic and adaptive approach to both education and employment. How can we ensure that our educational systems and labor market institutions evolve to effectively navigate this new reality? What new forms of signaling and screening will emerge in the coming years? This remains an open question, a challenge for both economists and policymakers to address as we move into the next phase of economic evolution. And with that, perhaps we can all drift off to sleep with those ponderings. Good night. Chapter 21. The Credential Inflation Problem. A Race to the Bottom. Last time, we explored how education acts as a signal in the job market, allowing employers to infer a candidate's potential productivity. Today, we delve into a darker side of this signaling process. Credential inflation, a phenomenon that, left unchecked, can resemble a self-defeating race to the bottom. Imagine a perfectly still pond. A single pebble dropped into its surface creates ripples, clear and distinct. That pebble represents a newly introduced credential, say, a bachelor's degree, that initially signals high ability and potential. Employers, eager to identify the most promising candidates, value this credential highly. Individuals, recognizing this advantage, invest in acquiring it. The pond is calm, the signal is clear. However, as more and more individuals obtain the bachelor's degree, the ripples begin to overlap, losing their distinctness. The signal weakens. What was once a valuable differentiator becomes merely the baseline expectation. This is the heart of credential inflation. The relative value of the credential diminishes as its prevalence increases. The underlying cause. The signal is based on relative scarcity. The value isn't intrinsic to the degree itself, but rather stems from its ability to differentiate the holder from others. When the vast majority possess the same credential, it no longer serves this purpose effectively. This echoes a fundamental principle of supply and demand. As supply increases, all else being equal, the value decreases. The classical economist, observing this phenomenon, might argue that the market is simply adjusting. He might propose that the labor market seeks a new, more discriminating signal. And indeed, it often does. This is where the race begins. Individuals, now facing a saturated market for bachelor's degree holders, seek additional credentials to regain a competitive edge, perhaps a master's degree, specialized certifications, or even a doctorate. These new credentials, like larger pebbles, initially create stronger, clearer ripples. But the cycle inevitably repeats. As the market becomes increasingly saturated with these advanced credentials, their signaling power erodes as well. We observe individuals pursuing increasingly higher levels of education and training simply to maintain their position in the labor market, a situation where they are essentially running in place. The initial promise of upward mobility through education becomes obscured by the need to perpetually acquire ever more expensive and time-consuming qualifications. This race to the bottom has several significant consequences. Firstly, it inflates the costs of education, placing a significant financial burden on individuals and families. Students accumulate substantial debt, often with uncertain returns on their investment. The policymaker, concerned about equitable access, might worry that this escalating cost creates barriers for individuals from disadvantaged backgrounds, exacerbating existing inequalities. Secondly, it leads to overqualification. Individuals with advanced degrees may find themselves working in jobs that don't fully utilize their skills and knowledge. This represents a misallocation of resources, as society invests in human capital that is ultimately underutilized. It also contributes to job dissatisfaction and lower productivity, as individuals feel frustrated and unfulfilled in their role. The skilled laborer, stuck in a job that doesn't reflect his talents, feels the weight of this wasted potential. Thirdly, it can distort the educational system itself. Universities and colleges may feel pressure to offer more advanced degrees and specialized programs, even if the market demand for these qualifications is limited. This can lead to a proliferation of programs that are ultimately not well aligned with the needs of the economy. The curriculum designer might struggle to balance the need for practical skills with the demand for advanced theoretical knowledge. So, what are the potential solutions? The policymaker might consider interventions such as stricter accreditation standards to ensure that credentials genuinely reflect valuable skills and knowledge. Alternatively, greater emphasis could be placed on skills-based hiring, where employers focus on demonstrable abilities rather than solely on educational qualifications. There is also a growing movement towards alternative forms of signaling, such as portfolios and micro-credentials, that may offer more granular and relevant assessments of individual capabilities. Ultimately, addressing credential inflation requires a fundamental shift in perspective. We must move away from the assumption that more education is always better, and instead, focus on aligning education and training with the actual needs of the labor market. This involves fostering greater collaboration between educational institutions, employers, and policymakers to ensure that individuals acquire the skills and knowledge that are truly valued in the workplace. The equilibrium state remains elusive. Is it possible to recalibrate the signaling system to a sustainable beneficial balance, or are we perpetually doomed to chase an ever-receding horizon of credentials? What new forms of value creation and signaling will emerge in the next phase of our economic journey? Chapter 22: Alternative Education Pathways. Vocational training and apprenticeships. Tonight, we consider vocational training and apprenticeships not as mere alternatives in a secondary sense, but as distinct and powerful engines of human capital formation. To truly appreciate their significance, we must revisit a fundamental economic concept: signaling and screening. Think of it as a subtle dance between potential employees and employers, a ballet of information and inference in the pre-employment arena. Signaling, in its purest form, involves individuals actively conveying information about their abilities to potential employers. Education, in the conventional sense of a university degree, often functions as a signal. The very act of acquiring a degree, enduring years of study, passing examinations, and achieving a certain level of academic proficiency, signals to the employer certain qualities. These qualities might include intellectual capacity, discipline, perseverance, and the ability to learn and adapt. The degree itself is not necessarily a direct measure of job-specific skills, but rather a proxy for a suite of desirable characteristics. However, the signaling value of a traditional education can become blurred. As more individuals acquire degrees, the signal becomes weaker, less distinctive. This leads to what some economists call credential inflation. A bachelor's degree, once a strong signal, may now be a mere baseline expectation for many jobs. This dilution necessitates further signaling through advanced degrees, internships, or other demonstrable achievements. Screening, on the other hand, is an employer's attempt to discern the true abilities of potential employees. It involves the use of various methods, interviews, aptitude tests, background checks, to filter applicants and identify those most likely to succeed. In the context of traditional education, employers often rely on the reputation of the university as a screening mechanism. A graduate from a highly selective institution might be presumed to possess a higher level of ability than a graduate from a less selective institution, even if their degree programs are similar. The policymaker understands this intimately. Now, let us consider vocational training and apprenticeships through this lens of signaling and screening. Here, the signal is often far more direct. A certified welder, a licensed electrician, or a skilled machinist is signaling a very specific and demonstrable set of abilities. The training itself is inherently practical, focusing on the acquisition of skills directly relevant to the job market. The credential, the certificate of completion, is not a proxy for general intelligence or adaptability, but rather a guarantee of competence in a particular trade. The employer, in turn, can engage in a more targeted screening process. Instead of relying on the abstract reputation of an academic institution, they can assess the candidate's skills through practical tests, simulations, or even trial periods. This direct assessment minimizes the risk of hiring someone who lacks the necessary skills, even if they possess impressive academic credentials. Consider for a moment the economic implications of warranties. A warranty, in essence, is the signal of confidence from the manufacturer. It assures the consumer that the product is of sufficient quality to withstand normal use for a specified period. Similarly, a vocational training program or apprenticeship, with its emphasis on practical skills and direct assessment, can be viewed as a warranty on the employee's competence. It reduces the employer's risk and increases the employee's likelihood of success. Furthermore, vocational training and apprenticeships often foster stronger connections between educational institutions and employers. These programs are frequently designed in collaboration with industry partners, ensuring that the curriculum remains relevant and that graduates possess the skills demanded by the labor market. This close collaboration reduces the information asymmetry that can plague the traditional education system, where there can be a disconnect between what is taught in the classroom and what is required on the job. From the perspective of the classical economist, the beauty of vocational training lies in its efficiency. It streamlines the signaling and screening process, reducing the costs associated with information gathering and risk assessment. It provides a more direct pathway to employment, particularly for individuals who may not thrive in a traditional academic environment. However, these pathways are not without their challenges. Vocational training may be perceived as less prestigious than a traditional university degree, potentially limiting career advancement opportunities in certain fields. Furthermore, the specific skills acquired may become obsolete as technology evolves, requiring ongoing training and adaptation. The fluidity of modern skills needs constant consideration. Ultimately, the optimal balance between traditional education and vocational training depends on a variety of factors, including individual aptitudes, career aspirations, and the demands of the labor market. A diversified educational ecosystem, offering a range of pathways to economic participation, is essential for fostering a resilient and adaptable workforce. As we move forward, the question remains: how can we ensure that all educational pathways are valued and accessible, allowing individuals to reach their full economic potential, regardless of their chosen route? This is the lingering inquiry as we prepare to navigate the evolving currents of economic evolution. The rise of online learning, MOOCs, and digital credentials tonight will gently shift our focus from the broad landscape of human capital investment to a specific, rather modern tributary feeding into that vast river. The rise of online learning, particularly massive open online courses, or MOOCs, and the emergence of digital credentials. We'll observe this through the lens of signaling and screening, a theoretical framework that helps us understand how education functions within the labor market, mirroring, in some ways, the economic role of warranties in consumer goods. Recall that signaling refers to actions taken by individuals to credibly convey information about themselves to others. Screening, on the other hand, is the process by which individuals, or more often firms, attempt to discern the true characteristics of others, often by observing those signals. Education, in this context, becomes less about the accumulation of specific knowledge and more about the demonstration of underlying qualities like diligence, intelligence, and the ability to learn. It's a complex interplay, a dance between the prospective employee and the employer. For decades, the traditional university degree served as the dominant signal. The successful completion of a bachelor's or master's program conveyed, rightly or wrongly, a package of attributes deemed valuable by employers. But the world is evolving. The neatly packaged signal of the conventional degree, while still possessing significant weight, is now being challenged by a more fragmented, perhaps more democratic, landscape of online learning. MOOCs, with their accessibility and relatively low cost, offer a potentially powerful means of signaling. Individuals can take courses in specific areas of expertise, demonstrating their interest and competence to potential employers. They can acquire certificates, badges, and other digital credentials that, theoretically, can be used to showcase specific skills and knowledge. But the effectiveness of these signals hinges on their perceived credibility. Consider the parallel with warranties. A manufacturer offers a warranty to signal the quality and reliability of its product. The longer the warranty, the stronger the signal. However, the signal is only effective if the warranty is credible, if the manufacturer is financially stable and likely to honor its commitments. Similarly, the value of a MOOC-based credential depends on the reputation of the institution offering the course, the rigor of the assessment process, and the perceived relevance of the curriculum to the needs of the labor market. One of the key challenges in the realm of online learning is addressing the information asymmetry between employers and potential employees. Employers struggle to differentiate between individuals who have genuinely acquired skills and those who have simply completed a course without demonstrating true mastery. This is where sophisticated screening mechanisms become crucial. Employers might implement their own skills assessments, coding challenges, or project-based interviews to validate the claims made by individuals with online credentials. The rise of digital credentials also presents an opportunity to move beyond the traditional degree as gatekeeper model. In theory, individuals can assemble a portfolio of micro-credentials, each representing a specific skill or competency, thereby creating a more granular and personalized representation of their abilities. This could potentially level the playing field, allowing individuals from diverse backgrounds to showcase their talents and access opportunities that were previously unavailable to them. However, the transition to this more fragmented and personalized system is not without its challenges. The policymaker must grapple with questions of standardization, accreditation, and the potential for fraud. How can we ensure that digital credentials are meaningful and trustworthy? How can we prevent individuals from falsely claiming competencies they do not possess? The classical economist might argue that market forces will eventually sort things out, with employers gravitating towards credentials that have proven to be reliable predictors of job performance. But there is a role for government and industry to play in establishing standards and promoting transparency. Furthermore, the proliferation of online learning platforms and credentials raises questions about the future of traditional educational institutions. Will universities adapt and integrate online learning into their offerings, or will they be displaced by more agile and specialized providers? Will the value of a traditional degree diminish as employers place greater emphasis on specific skills and competencies, regardless of where they were acquired? The answers to these questions are still unfolding. The rise of online learning is a dynamic and complex phenomenon, shaped by technological innovation, market forces, and evolving societal norms. It represents both an opportunity and a challenge, a chance to democratize access to education and improve the efficiency of the labor market, but also a potential source of confusion and inequality if not managed carefully. And as we observe this shift, this balancing act between traditional and digital education, we must ponder what new economic models will emerge as artificial intelligence begins not only to teach, but also to assess learning and talent, a phase we shall explore in the coming sessions. Chapter 24. Employer Branding, Attracting Top Talent Through Signaling. Good evening. Tonight, we delve into the fascinating interplay between employer branding and the economic concept of signaling. Consider, if you will, the labor market. It's a swirling eddy of individuals seeking opportunities and organizations searching for skilled hands and minds. But how does an employer, shrouded in the complexities of its internal operations, communicate its true value proposition to potential employees? And conversely, how do job seekers, often lacking readily verifiable evidence of their abilities, convey their worth? This, my friends, is where the theory of signaling becomes particularly relevant. Signaling, at its core, is the process by which one party conveys information to another party through actions that are costly or difficult to imitate. Think of it as a dance, a delicate choreography of communication designed to bridge the information gap inherent in situations of asymmetric information. The information asymmetry is the difference between what the organization and the individual know about each other. One of the earliest and most enduring applications of signaling theory is in the realm of education. The classical economist, nearly half a century ago, posited that education, beyond simply imparting skills, serves as a signal of an individual's innate abilities, perseverance, and willingness to learn. A degree from a reputable institution, therefore, acts as a costly signal, separating those who are capable of navigating a rigorous academic environment from those who are not. This is not to say that education has no intrinsic value. Rather, it highlights the duality of its role. It simultaneously equips individuals with knowledge and signals their underlying qualities to potential employers. Similarly, warranties in product markets act as signals of product quality. A company that offers a generous warranty is signaling its confidence in the durability and reliability of its goods. The cost of fulfilling potential warranty claims serves as a deterrent to offering such guarantees for inferior products. The warranty becomes a credible signal because it's costly to offer if the product is subpar. Now, let's translate this concept to the arena of employer branding. An employer brand encompasses an organization's reputation as an employer, its values, its culture, and its employee value proposition. A strong employer brand acts as a signal, attracting top talent by conveying information about the organization's desirability as a place to work. But how does an employer signal its worth? Through a variety of channels, each acting as a form of costly, or at least difficult to fake, commitment. Consider, for example, generous employee benefits packages. These represent a significant financial investment and signal a commitment to employee well-being. Publicly lauded training programs, investment in professional development, and initiatives promoting work-life balance all communicate the same message. This is an organization that values its employee. Transparency in compensation and career progression opportunities are further signals. Openly sharing information about salaries and advancement pathways reduces the uncertainty for potential candidates and signals a commitment to fairness and meritocracy. Awards and recognition from industry bodies also provide external validation, strengthening the employer's reputation and signaling its commitment to excellence. Conversely, negative signals can be equally powerful. A high employee turnover rate, negative online reviews, or a reputation for poor management can deter even the most talented individuals. These negative signals are costly to ignore, as they reflect underlying issues within the organization that need addressing. The policymaker might consider this a critical aspect of market efficiency. Ensuring that employer branding is not merely a veneer, but a true reflection of the employee experience, is crucial for creating a healthy and competitive labor market. It allows talent to flow towards organizations that genuinely value their contributions, leading to greater productivity and innovation. In essence, employer branding is not simply about marketing. It's about building a reputation that speaks for itself, a reputation grounded in genuine values and a commitment to creating a positive employee experience. It's about designing costly signals that attract the right talent and retain them for the long term. Chapter 25. The role of internships and entry-level positions. Screening new hires. Tonight, we turn our attention to the subtle art of screening in the job market, specifically how internships and entry-level positions serve as crucial stages in this process. Consider it a filter, a meticulously designed sifting mechanism that separates the merely interested from the truly capable. This process is deeply intertwined with the economic concepts of signaling and screening, concepts that, when understood, illuminate the rationale behind many seemingly opaque hiring practices. Signaling, as we recall, is the act of conveying information about oneself to others. Education, in its formal sense, is often the most prominent signal. A university degree, for instance, signals a baseline level of cognitive ability, perseverance, and an adherence to structured learning. However, a degree, while valuable, is often an incomplete signal. It provides a broad indication, but it rarely offers a precise profile of an individual's practical skills or their fit within a specific organizational culture. That's where internships and entry-level roles enter the picture. They function as screening devices for employers, allowing them to observe a candidate's performance firsthand. Screening is the process by which one party attempts to elicit information from another party to reduce information asymmetry. Think of it as a deliberate attempt to discern the genuine signal from the noise. The classical economist might argue that, in a perfectly efficient market, signals would be perfectly informative, eliminating the need for extensive screening. Every graduate would perfectly embody the characteristics implied by their degree. But the real world, alas, is far from perfectly efficient. Information is imperfect, and individuals may possess hidden attributes, positive or negative, that are not immediately apparent. Internships, therefore, serve as a trial period, a microcosm of the full-time role. They allow employers to observe how a potential employee interacts with colleagues, handles tasks under pressure, and learns from mistakes. These observations provide a much richer and more nuanced understanding than a resume or interview ever could. The candidate, in turn, gets to assess the company culture and determine if it aligns with their values and career aspirations. It's a two-way screening process, a delicate dance of mutual discovery. Entry-level positions, while more permanent, still retain a significant screening function. They often involve a steeper learning curve and require a greater degree of adaptability. The first few months in an entry-level role are often a period of intensive evaluation, where the employer assesses the employee's potential for long-term growth and contribution to the organization. Think of it as a calibrating process, fine-tuning the initial signal provided by education and experience. Consider the perspective of the policymaker. Understanding this screening process is crucial for developing effective policies related to education and workforce development. If employers rely heavily on internships and entry-level positions as screening devices, then access to these opportunities becomes a critical determinant of career success. Policies that promote equitable access to internships, particularly for individuals from disadvantaged backgrounds, can help to level the playing field and ensure that talent is not overlooked due to socioeconomic factors. Furthermore, the prevalence of screening underscores the importance of developing practical skills and cultivating soft skills, such as communication and teamwork. While a strong academic record is undoubtedly valuable, employers are increasingly seeking individuals who can demonstrate their ability to apply their knowledge in real-world settings. Education systems, therefore, must strive to bridge the gap between theory and practice, providing students with opportunities to develop these essential skills. The signaling and screening game continues throughout one's career, evolving with each new role and responsibility. Certifications, advanced degrees, and professional development courses serve as ongoing signals of expertise and commitment. Performance reviews and promotion decisions act as screening mechanisms, evaluating an individual's continued suitability for increasingly challenging roles. The beauty, or perhaps the inherent challenge, of this economic system lies in its dynamic nature. The signals we transmit and the screening mechanisms we encounter are constantly evolving, reflecting the changing demands of the labor market and the ever-increasing complexity of the modern economy. It is a flow, a constant striving for balance. Chapter 26. Reference checks and background checks. Verifying information. Last time, we considered the potent signal of a college degree, its capacity to broadcast inherent abilities and diligence to potential employers. Now, let us gently shift our focus from the initial transmission of this signal to the art of its verification. We enter the realm of reference checks and background investigations, essential components of the economic dance known as signaling and screening. Recall that signaling, in its purest form, involves an individual undertaking a costly action, obtaining a degree, offering a warranty, to credibly convey information about their quality to a market participant. Screening, conversely, is the effort by the recipient of that signal, an employer, a consumer, to filter out the noise and ascertain the genuine value behind the gesture. Reference checks represent a straightforward screening mechanism. The prospective employer, having observed the signal of a well-crafted resume and perhaps an impressive interview, seeks corroboration. They contact individuals listed by the applicant as having direct knowledge of their past performance, skills, and character. Ideally, the reference provides an unbiased assessment, confirming or challenging the applicant's self-presentation. The inherent weakness, of course, lies in the selection bias. Applicants are unlikely to nominate referees who would offer negative appraisals. Still, even a carefully curated list can yield valuable insights, revealing patterns of behavior, strengths, and areas for potential growth. Background checks extend beyond references, probing deeper into an individual's history. These might involve verifying educational credentials, confirming employment history, or even delving into criminal records. The rationale is simple: to reduce the information asymmetry between the employer and the potential employee. Information asymmetry, as we've discussed, can lead to adverse selection. Without sufficient screening, the employer risks hiring someone who misrepresents their abilities or possesses undesirable traits that could harm the organization. The policymaker grapples with the ethical considerations here, constantly balancing the employer's need for information with the individual's right to privacy. Consider the economic underpinnings of warranties, a signal of product quality. A manufacturer offering a generous warranty is essentially betting on the durability and reliability of their product. But how does a consumer verify this signal? While some may consult product reviews, the ultimate verification occurs over time, through the actual performance of the product. If the product fails prematurely, the warranty provides a mechanism for redress, incentivizing the manufacturer to maintain quality standards. The classical economist understood this implicitly, recognizing that repeat purchases are the lifeblood of a sustainable business. In the job market, the probationary period serves a similar function. It's a period of intense, real-world screening, allowing the employer to observe the employee's performance firsthand. The signals conveyed during the interview process are put to the test, revealing the true nature of the candidate's skills, work ethic, and cultural fit. This period of observation reduces the risk of a costly hiring mistake. If the employee fails to meet expectations, they can be terminated with relative ease, minimizing the long-term financial burden. The effectiveness of both reference and background checks hinges on the cost of providing false information. If the consequences of lying on a resume are minimal, the incentive to do so increases. Conversely, if employers actively verify claims and penalize dishonesty, the value of truthful signaling is enhanced. This creates a delicate equilibrium, a self-regulating system where the benefits of honesty outweigh the risks of deception. Ultimately, the process of signaling and screening is a continuous loop, a feedback mechanism that drives efficiency in the job market and beyond. It's a dance between those seeking to convey information and those seeking to verify its accuracy. As technology advances, the tools for both signaling and screening become ever more sophisticated, leading to a more nuanced and potentially more efficient allocation of resources. But does increased access to information guarantee better hiring decisions? Or does the sheer volume of data create new challenges, overwhelming employers and obscuring the signals that truly matter? This is a question we will consider as we move forward, gently probing the intricacies of information in the modern economic landscape. Chapter 27: Personality Assessments and Cognitive Tests. Predicting job performance. Tonight, we turn our attention to a specific application of human capital theory, the realm of personality assessments and cognitive tests in the context of job performance. These tools, often employed in hiring processes, represent an attempt to solve a fundamental information asymmetry problem. Employers lack complete knowledge of a candidate's true abilities and potential. In essence, they are strategies related to signaling and screening, mirroring how education and warranties function in other markets. Consider education, a signal par excellence. The act of acquiring a degree, irrespective of the specific knowledge gained, transmits information to potential employers. It signals diligence, perseverance, and a capacity for structured learning. A prospective employee invests time and resources, signaling their inherent value and dedication. The employer, in turn, interprets this signal, adding to their perception of the candidate. However, as the signaling theory emphasizes, it's crucial to account for the sheepskin effect, where the mere attainment of the degree matters most. perhaps even outweighing the knowledge gain. A potential employee's ability to get to the finish line becomes the primary factor, a signal that outweighs skill. Personality assessments and cognitive tests attempt to refine this signal. They are, in effect, screening mechanisms. The employer, facing a pool of candidates, needs to separate those who possess the desired traits and abilities from those who do not. Cognitive tests, designed to measure aptitude and intelligence, offer a direct, albeit imperfect, window into a candidate's cognitive capabilities. They aim to quantify raw intellectual horsepower, reflecting the speed and efficiency with which an individual can process information and solve problems. These tests are imperfect, but they allow the hiring manager to gain valuable perspective, separating the wheat from the chaff. Personality assessments delve into the softer skills: conscientiousness, agreeableness, extroversion, neuroticism, and openness to experience. These traits, collectively known as the Big Five, are thought to influence an individual's behavior and interactions in the workplace. Conscientiousness, for instance, is a strong predictor of job performance across various roles. A conscientious individual tends to be organized, responsible, and detail-oriented. Extroversion can relate to roles that require more interaction and teamwork. The economic rationale behind using these assessments is straightforward. Imperfect information creates inefficiencies. Employers risk hiring individuals who are ill-suited for the job, leading to decreased productivity, increased turnover, and ultimately, reduced profitability. By using these tools, employers hope to reduce this risk, improving the quality of their hiring decisions and maximizing their return on investment in human capital. However, the use of these assessments is not without its challenges. One major concern is their validity and reliability. Do these tests actually measure what they claim to measure? Are the results consistent over time? Cultural biases can creep into the design and interpretation of these assessments, leading to unfair or discriminatory outcomes. A test designed and normed in one culture may not be suitable for use in another, potentially disadvantaging individuals from diverse backgrounds. The classical economist may argue that this is a market efficiency. The labor pool is adjusting for the best fit. The policymaker may then argue for greater controls to prevent abuses. Furthermore, there is the risk of gaming the system. Candidates, aware of the traits and abilities that employers are seeking, may attempt to manipulate their responses to present a more favorable image. This strategic behavior undermines the validity of the assessments, reducing their predictive power. The system needs to be carefully balanced, allowing for valuable insight while guarding against manipulation. Finally, it is crucial to remember that these assessments are merely tools. They should not be the sole basis for hiring decisions. They provide valuable information, but they should be considered in conjunction with other factors, such as experience, skills, and cultural fit. A holistic approach to hiring, incorporating multiple sources of information, is more likely to lead to successful outcomes. In essence, personality assessments and cognitive tests function as warranties on human capital.io. They provide employers with a degree of assurance, albeit an imperfect one, that a candidate possesses the qualities and abilities required for success. They are attempts to navigate the complexities of the job market, reducing information asymmetry and improving the efficiency of the matching process. It is a fluid system, and these types of assessments are in constant flux. The impact of diversity and inclusion initiatives, signaling commitment. Good evening. Tonight, we delve into a fascinating intersection: the application of signaling theory to diversity and inclusion initiatives. We've previously discussed the potential for D&I to enhance innovation and productivity. But beyond these internal benefits lies a powerful external message. D&I programs, when thoughtfully implemented, act as signals, communicating valuable information about a firm's values and operational excellence. Signaling theory, as you recall, addresses situations of asymmetric information. One party, typically the seller or the employer, possesses more information than the other, the buyer or the potential employee. The challenge then becomes, how can the informed party credibly convey this information to the less informed? Education, warranties, and even job interviews can all be interpreted through this lens. In the context of D&I, the firm seeks to signal its commitment to fairness, meritocracy, and long-term sustainability. The classical economist might argue that markets are inherently efficient, and true merit will always be recognized. However, this idealized view often clashes with reality. Imperfect information, biases, and network effects can all distort the allocation of talent. D&I initiatives, therefore, represent an attempt to correct for these market failures and ensure a more equitable playing field. Consider a firm that invests heavily in D&I training, implements blind resume reviews, and establishes employee resource groups. These actions are not costless. They require resources, time, and a genuine commitment from leadership. The very fact that the firm is willing to bear these costs signals to the outside world, potential employees, investors, and consumers, that it values diversity and inclusion. This signal can attract a wider pool of talent. Individuals from underrepresented groups, who might otherwise be hesitant to apply, are more likely to see the firm as a welcoming and supportive environment. This expanded talent pool, in turn, allows the firm to recruit the best and brightest, regardless of background. Furthermore, a strong D&I signal can enhance the firm's reputation. Consumers are increasingly aware of social issues and are more likely to support companies that align with their values. Investors, too, are paying closer attention to environmental, social, and governance factors, including D&I. A firm with a demonstrable commitment to diversity can attract socially responsible investment, lowering its cost of capital. However, the signal must be authentic. A superficial or tokenistic approach to D&I can backfire, leading to accusations of diversity washing and damaging the firm's reputation. The policymaker understands this risk. Credible D&I initiatives require genuine commitment from the top, measurable goals, and transparent reporting. Think of it as a delicate balance. The firm must invest enough in D&I to credibly signal its commitment, but not so much that it becomes unsustainable or distorts the decision-making process. The optimal level of investment will vary depending on the industry, the firm's size, and its specific context. Moreover, D&I initiatives can also function as screening mechanisms. By observing how effectively a firm implements and manages its D&I programs, potential employees can gain insights into the firm's culture and values. This allows them to make more informed decisions about whether to accept a job offer. The economic power of D&I as a signal is further amplified when we consider the network effects. As more firms adopt robust D&I programs, the norm shifts, and it becomes increasingly difficult for other firms to ignore the issue. This creates a virtuous cycle where competition for talent and capital drives further investment in D&I. In conclusion, D&I initiatives are not simply altruistic endeavors. They are strategic investments that can enhance a firm's reputation, attract talent, and improve its bottom line. By understanding the signaling effects of D&I, firms can make more informed decisions about how to allocate resources and create a more inclusive and equitable workplace. Networking as a signal, building relationships and accessing opportunities. We've traversed the landscape of information asymmetry, observing how imbalances in knowledge shape economic outcomes. Now, let us turn our gaze toward a particularly human endeavor, networking, and understand it through the lens of signaling and screening. Networking, at its heart, is a dynamic process of conveying information and assessing potential, much like the educational credentials we previously discussed. The core concept here is this: information is often hidden. Employers can't perfectly know a candidate's work ethic or skills before hiring them. Individuals can't be certain of a company's culture or growth potential before accepting a job. Thus, both sides seek signals, readily observable actions or characteristics that hint at underlying qualities. Education, as we've seen, acts as a powerful signal. A degree from a reputable institution doesn't guarantee competence, but it indicates a certain level of intelligence, discipline, and perseverance. Networking operates in a similar vein. Attending industry events, joining professional organizations, and engaging in online discussions are all activities that broadcast a signal. They suggest a proactive nature, a commitment to one's field, and a willingness to learn and connect. The mere act of networking, especially strategic networking, can separate you from the mass of individuals who remain passive. It subtly announces, I am engaged. I am interested. I am seeking opportunities. But signaling is only half the equation. The other half is screening. Just as universities screen applicants based on their academic records and standardized test scores, individuals and organizations screen potential connections based on their networking behavior. A well-crafted LinkedIn profile, a thoughtful comment on a blog post, a genuine question asked at a conference. These are all data points that others use to assess your value and suitability. The elegance of networking as a signaling mechanism lies in its interactive nature. Unlike a static resume, which simply presents past accomplishments, networking allows for dynamic exchange and real-time assessment. You can observe how someone interacts with others, how they handle challenging questions, and how they articulate their ideas. This provides richer information than any piece of paper ever could. Consider the subtle signals conveyed during a networking conversation. A well-placed question about a company's recent challenges demonstrates genuine interest and critical thinking. Sharing a relevant article or insight showcases knowledge and generosity. Actively listening and responding thoughtfully signals respect and empathy. These seemingly small gestures contribute to a larger impression, shaping how others perceive your capabilities and potential. Of course, like any signaling mechanism, networking is not without its imperfections. It can be gamed. Individuals can exaggerate their accomplishments or cultivate superficial connections. The key is to focus on building genuine relationships based on mutual value and shared interests. Authenticity is a powerful signal in itself, often more effective than contrived displays of competence. Think of networking as a carefully calibrated dance. Each participant is both sending and receiving signals, constantly adjusting their movements based on the information they gather. The more skilled the dancers, the smoother and more rewarding the interaction becomes. And just as a skilled dancer anticipates their partner's movements, a skilled networker anticipates the needs and expectations of their connections. From an economic perspective, effective networking reduces information asymmetry in the labor market. It allows employers to gain a more nuanced understanding of potential candidates, and it allows individuals to discover opportunities that might otherwise remain hidden. By fostering connections and facilitating the exchange of information, networking contributes to a more efficient and dynamic allocation of talent. As the classical economists would say, effective networking reduces transaction costs. It simplifies the process of finding the right person for the right role, ultimately leading to greater productivity and economic growth. The policymaker might encourage initiatives that promote networking opportunities, recognizing its importance and fostering innovation and entrepreneurship. In conclusion, networking serves as a vital signaling mechanism in the modern economy. By actively engaging in building relationships and sharing information, individuals can enhance their visibility, access opportunities, and ultimately contribute to a more efficient and interconnected marketplace. As we prepare to transition, we might ponder, how does the evolving landscape of digital communication further reshape the dynamics of signaling and screening in networking? Chapter 30. The Gig Economy. Signaling competence in short-term contracts. Ah, yes. We've traversed the broader landscape of information asymmetry, particularly how it manifests in education and product warranties. Now, let's turn our gaze to a more contemporary manifestation of these principles: the burgeoning gig economy. The gig economy, characterized by short-term contracts and freelance work, presents a fascinating case study in signaling and screening. In traditional, long-term employment, a resume, a carefully crafted interview, and perhaps a probationary period serve as mechanisms for employers to assess a candidate's competence. These are, in essence, signals sent by the potential employee and screening tools employed by the employer. But what happens when the employment relationship is compressed, sometimes lasting only a few hours or days? The usual signaling and screening mechanisms become inadequate. The resume loses some of its luster, the interview is often bypassed entirely, and there's no time for a probationary period. This creates a heightened information asymmetry. How can a client, seeking a freelancer for a specific task, discern competence from mere claims of ability? One crucial signal, and perhaps the most potent in the gig economy, is reputation. Platforms like Upwork or Fiverr are built upon systems of ratings and reviews. These reviews, provided by past clients, act as a collective assessment of a freelancer's skills, reliability, and professionalism. They are, in effect, a crowdsourced screening mechanism. A freelancer with a consistently high rating is signaling competence and trustworthiness, making them a more attractive prospect. However, even reputation systems are not without their imperfections. Newcomers to the platform face a cold start problem. They lack a history of reviews, making it difficult to signal their competence. They must often accept lower-paying jobs or offer substantial discounts to build a positive reputation. This creates a barrier to entry, potentially stifling innovation and competition. The market favors the established players, even if newcomers possess comparable or even superior skills. This is an echo of the difficulties faced by any new entrant into an established market, irrespective of the employment structure. Another signaling mechanism employed in the gig economy is portfolio development. Freelancers showcase their past work to demonstrate their capabilities. A graphic designer might present a collection of logos they've created. A writer might display articles they've published, or a programmer might share code repositories they've contributed to. A well-curated portfolio serves as tangible evidence of skills and experience, acting as a powerful signal of competence. Certification, in the form of online courses and industry-recognized qualifications, can also serve as a signaling device. The classical economist might argue that such certifications are only valuable if they genuinely reflect underlying competence. A meaningless certificate easily obtained will ultimately fail to signal anything of substance. The policymaker, however, might see value in standardized certifications as a means of reducing information asymmetry and promoting a more level playing field within the gig economy. The debate continues, of course, mirroring discussions around the true value of traditional educational qualifications. The gig economy, therefore, presents a fascinating microcosm of the broader economic forces at play. It is a market driven by information, or rather, the lack of it. The success of freelancers hinges on their ability to effectively signal their competence, and the ability of clients to efficiently screen potential candidates. The efficiency of these signaling and screening mechanisms directly impacts the overall efficiency of the gig economy itself. As we move forward, it's worth considering the long-term implications of the gig economy on the labor market. Will the rise of short-term contracts lead to a decline in traditional employment? Will the emphasis on signaling through reputation and portfolio development reshape the skills and qualifications employers value? And what will be the effect of AI and automation upon this uniquely precarious, and yet undeniably powerful, economic force? The next phase, it seems, will bring more questions than answers. Chapter 31. Platform Economies and Rating Systems. Building online reputations. Last time, we examined the architecture of information asymmetry, the uneven landscape where one party possesses more knowledge than the other. Now, we turn our attention to how actors within an economy attempt to level that playing field, to signal their quality, and screen out those who do not meet their standards. The digital realm, and particularly platform economies, offers a fertile ground for observing these dynamic processes. Think of Uber, Airbnb, Etsy, all environments heavily reliant on reputation, a digital proxy for trust. The core challenge is this: how do we convey credible information about ourselves or our offerings in a world of uncertainty? This is where signaling comes into play. Signaling is the conscious effort to transmit information that differentiates a good or service, or indeed, a person, from its competitors. The higher the cost of faking the signal, the more credible it becomes. The classical economist understood this intuitively, noting how expensive advertising campaigns, for example, could serve as a signal of a firm's belief in its product's longevity and quality. If the product were truly subpar, the advertising investment would be a sunk cost with little return. Education, warranties, and job markets offer enduring real-world examples. Think about the student diligently pursuing a degree. They are, in essence, signaling their aptitude, discipline, and intellectual curiosity to potential employers. The cost? Years of study, tuition fees, and foregone earnings. This cost, however, makes the signal credible. Not everyone is willing or able to bear this burden. Similarly, a comprehensive warranty on a product serves as a signal of the manufacturer's confidence in its durability and reliability. The policymaker might consider how regulations surrounding advertising or product labeling can enhance the clarity and reliability of these signals, ensuring consumers are not misled. In platform economies, rating systems become the primary mechanism for signaling and screening. Consider a freelance writer on a platform like Upwork. Their star rating, number of completed projects, and client testimonials serve as signals of their competence and professionalism. These signals are not without their complexities. A new freelancer may struggle to build a reputation, facing a cold start problem. Conversely, established freelancers may benefit from a halo effect, where positive past performance overshadows occasional setbacks. Screening, on the other hand, is the process by which one party attempts to extract information from another. A potential employer, for instance, screens job applicants through resumes, interviews, and reference checks. They are actively seeking to identify candidates who possess the requisite skills and experience. On platforms, screening often takes the form of reviewing profiles, reading reviews, and communicating directly with potential service providers. Algorithmic ranking systems also play a crucial role in screening, prioritizing listings based on factors such as ratings, response times, and completion rates. The developer understands that these algorithms, though seemingly objective, can also introduce biases, potentially disadvantaging certain individuals or groups. However, reputation systems are not without their flaws. Manipulation, collusion, and the potential for biased reviews can undermine their effectiveness. Gaming the system through fake reviews or coordinated rating schemes is an ongoing challenge. Furthermore, the emphasis on quantifiable metrics can lead to a homogenization of services, discouraging innovation and risk-taking. The entrepreneur might be tempted to prioritize short-term gains by manipulating the rating system, but long-term success hinges on building genuine trust and delivering consistent quality. Ultimately, the effectiveness of signaling and screening mechanisms depends on the transparency, integrity, and accessibility of information. Platforms must continually adapt their algorithms and policies to mitigate the risks of manipulation and ensure that ratings accurately reflect the quality of goods and services. The future lies in developing more nuanced and sophisticated reputation systems, perhaps incorporating elements of social network analysis and behavioral economics. How do we move beyond simple star ratings to capture the richness and complexity of human interactions and judgments in the digital sphere? That is a question for another time, as the gentle hum of the night envelops us. The impact of social media, LinkedIn, and professional branding. We've drifted from the broad currents of global trade winds towards the more intimate eddies of individual economic actors. Having explored the landscape of information asymmetry, we now turn our gaze to how individuals attempt to navigate that very challenge, specifically within the professional realm. Our focus tonight rests on the digital landscape of LinkedIn and its role in professional branding, examined through the lens of signaling and screening. At its core, the theory of signaling and screening addresses the inherent imbalance of information in markets. A seller typically knows more about the quality of their product than the buyer. In the job market, a prospective employee knows far more about their skills, work ethic, and potential than a potential employer can ascertain through a brief resume and a few interviews. This asymmetry creates friction. How can the worker effectively signal their value? And how can the employer screen candidates to identify the truly exceptional? The classical economist, pondering this dilemma, might point to education as a prime example of a signal. A university degree, particularly from a reputable institution, isn't merely about the knowledge gained. It's a costly signal of intelligence, perseverance, and the ability to conform to institutional expectations. The cost, tuition, time, effort, acts as a barrier, preventing those without the necessary qualities from easily mimicking the signal. A high GPA further refines the signal, suggesting an even greater level of dedication and competence. In essence, A degree functions as a warranty on the graduate's potential, albeit an imperfect one. Warranties, in the broader economic sense, are another key element of signaling. A manufacturer, confident in the reliability of their product, offers a generous warranty. This signals their belief in the product's durability and quality. It shifts some of the risk from the buyer to the seller, making the purchase more attractive. The cost of fulfilling warranty claims acts as a deterrent against offering warranties on inferior products. Now, consider LinkedIn within this framework. It is, in many ways, a sophisticated signaling and screening platform specifically designed for the professional world. Your profile becomes your digital resume, but with the added dimension of endorsements, recommendations, and displayed activity. These elements collectively form a personal brand, a carefully constructed signal intended to convey your value to potential employers and collaborators. Endorsements, for example, act as micro-warranties on specific skills. When colleagues attest to your proficiency in project management or data analysis, they are essentially co-signing your claim. The more reputable and numerous the endorsements, the stronger the signal becomes. Recommendations, akin to detailed references, provide richer context and offer a narrative validation of your abilities and character. However, the beauty and the complexity of LinkedIn lies in its interactive nature. It's not merely a static display of accomplishments. Active participation in professional groups, sharing insightful articles, and engaging in thoughtful discussions contribute to a more nuanced signal. These actions demonstrate a genuine interest in your field, a willingness to learn and contribute, and an ability to communicate effectively. In essence, they signal engagement beyond the bare minimum. The policymaker, observing this digital ecosystem, might be concerned about the potential for manipulation. Can the signal be easily faked? Are endorsements genuine reflections of ability, or simply reciprocal favors? Can individuals curate an artificially impressive online persona that doesn't accurately reflect their true skills? These are valid concerns, and the effectiveness of LinkedIn as a signaling mechanism depends on the integrity of its users and the platform's ability to detect and discourage fraudulent activity. Employers, on the screening side, are increasingly sophisticated in their use of LinkedIn. They go beyond simply scanning resumes. They delve into profiles, scrutinize endorsements and recommendations, and assess the overall consistency and authenticity of the online persona. They are looking for signals that transcend the standard qualifications, evidence of genuine passion, intellectual curiosity, and a strong work ethic. The system, therefore, is in a constant state of flux. Individuals are continually refining their signaling strategies, while employers are developing more discerning screening techniques. The digital realm has amplified the age-old economic dance of information asymmetry, creating new opportunities and new challenges for both job seekers and employers. And so, as we conclude, consider this. As artificial intelligence and machine learning become more integrated into both the signaling and screening processes, how will the nature of professional branding, and indeed, the very definition of skill, evolve in the digital age? That question, perhaps, will illuminate our path forward. The future of education. Adapting to the changing job market. Welcome back. Having explored the intricacies of labor mobility, our journey now leads us to contemplate something even more fundamental: the very purpose of education in a world of accelerating change. We often speak of education as an investment, but what kind of investment? What return are we truly seeking, and how does the market signal and screen those returns? Consider, if you will, the economic concept of signaling and screening. In essence, this theory suggests that education serves not only to impart knowledge and skills, but also, and perhaps more importantly, to signal inherent qualities to potential employers. Think of it as a carefully crafted message sent through the medium of academic achievement. The higher the degree, the more prestigious the institution, the stronger the signal supposedly becomes. The rationale behind this lies in the inherent problem of asymmetric information. The employer, upon interviewing a candidate, possesses far less information about their true capabilities than the candidate themselves. A resume, after all, is a curated highlight reel, not a complete and unflinching autobiography. So, how does an employer sift through the noise and identify genuinely promising individuals? This is where the screening process comes into play. Employers, acting as rational actors, use education as a readily available, albeit imperfect, proxy for characteristics they value: diligence, intelligence, the ability to learn, and the capacity for sustained effort. A diploma, therefore, becomes a screen through which candidates must pass to even be considered for certain roles. The parallel to product warranties is instructive. A warranty, in its simplest form, is a signal from the manufacturer to the consumer, a statement of confidence in the product's quality. Similarly, a degree can be interpreted as a warranty from the educational institution, assuring the employer of a certain level of competence. However, just as a warranty doesn't guarantee perfection, a degree doesn't guarantee success. The classical economist might argue that this system, while imperfect, is fundamentally efficient. The cost of obtaining a degree, in terms of both time and money, acts as a self-selecting mechanism. Only those who believe they possess the inherent qualities to succeed will be willing to make the necessary investment. This reduces the employer's search costs and allows for a more streamlined hiring process. It's a balanced system, in theory. However, cracks begin to appear upon closer examination. What happens when the content of education becomes detached from the actual needs of the job market? What happens when the signaling value of a degree outweighs its intrinsic value? We see this manifested in the phenomenon of credential inflation, where employers demand increasingly higher levels of education for jobs that haven't actually become more complex. The policymaker, observing this trend, might consider intervention. Should the government subsidize specific fields of study that are in high demand? Should there be greater emphasis on vocational training and apprenticeships? These are complex questions, with no easy answers. Interventions can have unintended consequences, distorting market signals and creating new inefficiency. One potential solution lies in fostering closer collaboration between educational institutions and the private sector. Universities could partner with businesses to design curricula that are directly aligned with industry needs. Internships and apprenticeships could be integrated into academic programs, providing students with real-world experience and allowing employers to assess their capabilities in a more meaningful way. Furthermore, the rise of online learning and micro-credentials offers new opportunities for individuals to acquire skills and signal their competence to employers in a more targeted and cost-effective manner. These alternative pathways to education can challenge the traditional dominance of the four-year degree and create a more diverse and adaptable workforce. The key, it seems, lies in striking a balance. We need to preserve the signaling function of education, while ensuring that it also provides individuals with the knowledge and skills they need to thrive in a rapidly evolving job market. We must move beyond a system that simply screens for inherent qualities and create a system that actively cultivates talent and equips individuals with the tools they need to succeed. As we conclude, consider this. Are we entering an era where continuous learning and lifelong skill development become the primary signals of value, superseding the once definitive statement of a static degree? What new economic models will emerge to navigate this ever-shifting terrain of talent and opportunity? We shall turn towards this question and how governments respond in our next discourse. Chapter 34: Skills-Based Hiring. Moving beyond degrees, we've explored the landscape of technological disruption and its impact on the workforce. Now, let us turn our attention to a fascinating intersection of economics and human resources. Skills-based hiring, a movement challenging the traditional reliance on formal education as the primary signal of a candidate's worth. This shift directly engages with the economic concepts of signaling and screening, processes that govern how information, or the lack thereof, shapes decisions in markets, particularly the labor market. Imagine, if you will, a vast sea of potential employees. Employers, like ships at harbor, must choose whom to welcome aboard. Ideally, they seek individuals with the precise skills to navigate the turbulent waters of their respective industries. But information is often incomplete, clouded by superficial waves. This is where signaling comes into play. It's the art of conveying information about oneself, the candidate's skill level, work ethic, and potential to prospective employers. The most common signal, historically, has been the university degree. The classical economists might argue that a degree, especially from a prestigious institution, acts as a strong signal. It signifies that the individual has successfully navigated a rigorous academic curriculum, demonstrating intelligence, perseverance, and the ability to learn. These traits, it's assumed, translate into workplace competence. The degree becomes a convenient, albeit costly, shorthand for capability. However, this shorthand often overlooks a critical flaw. The correlation between academic achievement and job performance is not always as strong as we might assume. The waters of academia can be calm and predictable. The ocean of the working world is often anything but. Screening, on the other hand, is the process employers use to filter through these signals and identify the most promising candidates. Traditional screening heavily relies on resumes listing degrees and certifications. These act as initial filters, narrowing the pool of applicants before more in-depth evaluations take place. This reliance, however, can lead to credentialism, a situation where qualifications become more important than actual abilities. Individuals possessing the right credentials may be favored over those with superior skills, but lacking the formal paperwork. The policymaker, observing this imbalance, might advocate for a shift towards skills-based hiring. This approach prioritizes demonstrable skills and competencies over traditional qualifications. Instead of focusing solely on degrees, employers utilize various assessment methods to directly evaluate a candidate's abilities. These methods might include skills tests, work samples, simulations, and behavioral interviews designed to uncover practical knowledge and problem-solving capabilities. Think of it as charting the actual currents the candidate has navigated, rather than simply looking at their nautical school diploma. The rationale behind skills-based hiring is rooted in the understanding that many skills are acquired outside of formal education. Individuals may gain valuable experience through apprenticeships, on-the-job training, self-study, or volunteer work. These experiences, though often uncredentialed, can be just as, or even more, relevant to a specific job role than a traditional degree. Furthermore, a skills-based approach promotes greater diversity and inclusivity. By removing the degree requirement, employers can tap into a wider talent pool, reaching individuals who may have faced barriers to higher education due to socioeconomic factors or other systemic disadvantages. It levels the playing field, allowing skills to speak for themselves. However, the transition to skills-based hiring is not without its challenges. One significant hurdle is the development of reliable and valid assessment methods. Accurately measuring skills requires careful planning and execution. Tests must be designed to reflect the specific requirements of the job and must be free from bias. Furthermore, employers need to invest in training their hiring managers to effectively evaluate candidates based on skills rather than relying on familiar, but potentially misleading, credentials. There must be a rebalancing of the scales. Ultimately, the move towards skills-based hiring represents a recalibration of the signaling and screening mechanisms in the labor market. It acknowledges the limitations of traditional signals, such as degrees, and emphasizes the importance of directly assessing an individual's capabilities. By focusing on skills, employers can make more informed hiring decisions, unlock hidden talent, and create a more equitable and efficient workforce. This shift is not simply a trend. It is a necessary adaptation to the rapidly changing demands of the modern economy. As we consider this shift, a question lingers. How might the rise of artificial intelligence and automated assessment tools further reshape the landscape of skills evaluation? And what unintended consequences might arise from relying too heavily on algorithmic assessments in the hiring process? Chapter 35. The Role of Artificial Intelligence. Automating screening processes. Following our exploration of asymmetrical information and its impact on markets, particularly the labor market, we now turn our gaze towards a transformative technology, artificial intelligence, and its potential to reshape screening processes. Think of it as a digital sieve, sifting through mountains of data to discern the truly valuable grains. As we discussed, signaling and screening are crucial mechanisms to mitigate the adverse effects of information asymmetry. The prospective employee, possessing superior knowledge of their own skills and abilities, attempts to signal their worth through education, certifications, and carefully crafted resumes. Employers, in turn, employ screening processes, interviews, aptitude tests, background checks, to glean insights and identify the most suitable candidates. However, these traditional methods are often imperfect, costly, and subject to biases both conscious and unconscious. It's a system that works, but with considerable friction. Imagine a river flowing towards its destination, encountering numerous rocks and eddies that slow its progress. Enter artificial intelligence, or AI. At its core, AI is about automating tasks that typically require human intelligence. In the context of screening, this automation holds the promise of increased efficiency, reduced costs, and perhaps even greater objectivity. The algorithms, designed and trained on vast datasets, can analyze resumes, assess personality traits, and even conduct preliminary interviews, all with remarkable speed and consistency. This allows organizations to process a far larger pool of applicants, potentially uncovering hidden talent that might otherwise be overlooked. Consider the traditional resume review process. A human recruiter, faced with hundreds of applications, must painstakingly sift through each one, searching for keywords, evaluating experience, and assessing qualifications. This process is inherently subjective, influenced by personal biases and limited cognitive capacity. An AI-powered system, on the other hand, can perform this task with remarkable speed and accuracy, identifying candidates who meet specific criteria and flagging potential red flags. The classical economist, with a keen eye for efficiency, would undoubtedly appreciate the potential for cost savings and increased productivity. Furthermore, AI can be used to assess candidates beyond the confines of the resume. Natural language processing can analyze cover letters and other written materials, gauging communication skills and personality traits. Video analysis can assess nonverbal cues during video interviews, providing insights into a candidate's confidence and demeanor. These advanced techniques offer a more holistic view of the applicant, moving beyond the static information presented in a traditional resume. Think of it as adding depth and dimension to a two-dimensional image. However, the integration of AI into screening processes is not without its challenges. The policymaker must grapple with crucial ethical considerations. One major concern is the potential for algorithmic bias. If the data used to train the AI is itself biased, the resulting algorithm will likely perpetuate and even amplify those biases. This could lead to discriminatory outcomes, unfairly disadvantaging certain groups of candidates. Ensuring fairness and transparency in AI-driven screening processes is therefore paramount. Another challenge lies in the potential for gaming the system. As candidates become more aware of the criteria used by AI algorithms, they may attempt to optimize their resumes and profiles to match those criteria, even if they do not genuinely possess the required skills and experience. This creates a kind of arms race, with AI developers constantly striving to stay one step ahead of the game. It's a constant calibration, a dynamic equilibrium that requires vigilance. Moreover, the reliance on AI can potentially dehumanize the hiring process, reducing candidates to mere data points. The human touch, the ability to assess intangible qualities such as creativity, empathy, and cultural fit, remains crucial. A balanced approach, combining the efficiency and objectivity of AI with the nuanced judgment of human recruiters, is likely to be the most effective strategy. We must ensure that technology serves humanity, rather than the other way around. Ultimately, the role of AI in automating screening processes is still evolving. Its potential to transform the labor market is undeniable, but its implementation requires careful consideration of ethical implications and practical challenges. The river of progress flows onward, but we must navigate its currents with wisdom and foresight. As we embrace this new technology, we must continuously ask ourselves, how can we ensure that AI empowers both employers and job seekers, creating a more efficient and equitable labor market for all? This delicate balancing act is the next stage in our economic understanding, the next bend in the river we must navigate. Chapter 36. Blockchain and Secure Credentials, Verifying Education and Experience. Good evening. We've spent the last few sessions examining the ebb and flow of information asymmetries in the marketplace. Tonight, our current carries us towards a relatively new application, attempting to address these very asymmetries: the use of blockchain technology for secure credentials, particularly in verifying education and experience. This is, in essence, a modern attempt to refine the ancient art of signaling and screening. Let us recall the core concept: signaling. In our economic landscape, individuals and institutions often possess private information, knowledge hidden from the view of others. Education, warranties, and professional certifications all serve as signals. They are visible, verifiable demonstrations intended to convey underlying qualities or competencies to those who lack direct insight. The freshly minted graduate displays their diploma, hoping to signal competence to potential employers. The manufacturer offers a warranty, signaling the durability and reliability of their product. These are active attempts to bridge the information gap. However, signaling alone is insufficient. The signal must be credible. Here, the potential for deception arises. A fraudulent diploma carries no true weight. A warranty that is unenforceable offers no real assurance. This is where the concept of screening enters the equation. Screening involves actions taken by those receiving the signals to evaluate their validity and reliability. Employers conduct background checks. Consumers read product reviews. Regulators enforce warranty terms. The classical economist, in his idealized model, often assumes perfect information, or at least easily attainable information. But in reality, these processes of signaling and screening are costly and imperfect. Verifying credentials takes time and resources. Fraudulent claims can be difficult to detect. This inherent inefficiency creates a drag on the economic system, a friction that slows down the efficient allocation of resources and talent. Now, consider the promise of blockchain technology. At its heart, a blockchain is a distributed, immutable ledger. Information recorded on a blockchain is inherently transparent and difficult, if not impossible, to alter retroactively. This fundamental characteristic presents a powerful tool for creating and verifying credentials. Imagine a system where educational institutions directly issue degrees and certificates onto a blockchain. Employers could then instantly and securely verify the authenticity of these credentials, bypassing the often slow and cumbersome traditional methods. The friction is reduced. Similar applications extend to professional certifications, licenses, and even employment history. A doctor's license, recorded on a blockchain, becomes instantly verifiable by patients and hospitals. A tradesperson's certifications, securely stored and accessible, inspire confidence in potential clients. The reduction in verification costs and the increased certainty in the information significantly strengthens the signaling process. This doesn't imply a utopian solution, of course. The effectiveness of blockchain-based credentials hinges on the integrity of the issuers. A corrupt institution can still issue fraudulent credentials, even on a blockchain. Furthermore, ensuring universal adoption and interoperability between different blockchain systems presents a significant challenge. The policymaker must carefully consider the legal and regulatory framework surrounding these technologies, balancing innovation with consumer protection. We must remember that technology is simply a tool. Its effectiveness depends entirely on how it is wielded. Moreover, the focus on verifiable credentials may inadvertently exacerbate existing inequalities. Access to education and training is not evenly distributed. A system that privileges easily verifiable credentials might disadvantage those who lack formal qualifications, but possess valuable skills acquired through unconventional means. The labor market may become even more sharply divided based on digital validation. Ultimately, the integration of blockchain technology into the realm of education and experience verification represents a significant step towards addressing information asymmetries. By streamlining the signaling and screening processes, we can potentially unlock greater efficiency in the labor market and beyond. However, a cautious and thoughtful approach is essential, ensuring that these technologies are deployed in a way that promotes fairness and equity. As we observe its progress, what new forms of trust will be built on this immutable foundation? That is the question we shall perhaps ponder next time. The ethical implications of signaling and screening, fairness and bias. We've spent considerable time charting the mechanics of signaling and screening, observing how individuals strive to convey hidden information, and how institutions attempt to extract it. Tonight, however, our focus shifts. We move from the how to the should and ought. Our concern is not merely with the effectiveness of these mechanisms, but with their ethical ramifications, their potential for fairness, and equally important, their capacity to perpetuate bias. Recall the foundational premise: asymmetric information. One party knows something the other doesn't. This imbalance creates the space for signaling, the deliberate transmission of information, and screening, the strategic gathering of it. Education, warranties, even the structure of job interviews, all become tools in this complex game. But is the game fair? That is the question before us. Consider first the role of education as a signal. Ideally, education should be a conduit for knowledge, a pathway to intellectual and personal growth. Yet, in the signaling framework, it can become something quite different. A costly barrier to entry, a way to distinguish oneself not necessarily through inherent ability, but through the capacity to endure demanding and often expensive process. The student who diligently works to acquire skills and knowledge does so, in part, to signal those attributes to potential employers. However, access to education is not uniformly distributed. Socioeconomic factors, geographic location, and historical injustices all create uneven playing fields. The young person from a disadvantaged background may possess the same underlying talent as their more privileged counterpart, but they lack the resources to acquire the same level of education. The signal they can afford to send is weaker, not because of any inherent deficit, but because of systemic inequalities. The market, in its impartial operation, may perpetuate existing disparities, rewarding those who already possess an advantage. Similarly, consider warranties. These seemingly straightforward guarantees of product quality also function as signals. A firm confident in the durability of its goods is more likely to offer a generous warranty, thereby attracting discerning consumers. But what about firms that lack the resources to provide such assurances, even if their products are of comparable quality? A small startup, for instance, may be hesitant to offer a comprehensive warranty, fearing the financial risk. The consumer, lacking perfect information, may then gravitate towards the established brand with the more robust guarantee, even if the startup's product represents a better value. The warranty, intended to reduce uncertainty, can inadvertently create a barrier to entry for smaller, potentially more innovative companies. The job market is perhaps the most fertile ground for observing the ethical complexities of signaling and screening. Employers, seeking to identify qualified candidates, often rely on proxies, credentials, experience, even the way someone answers seemingly innocuous questions. These proxies act as signals, providing glimpses into a candidate's hidden attributes. However, these signals can be profoundly biased. A hiring algorithm, trained on historical data reflecting existing societal biases, may perpetuate those biases in its selection criteria. A candidate from an underrepresented group may be overlooked not because of a lack of qualifications, but because their signals, their experiences, their communication style do not conform to the algorithm's expectations. The system, designed to be efficient, becomes an engine of discrimination. The policymaker, faced with these ethical dilemmas, must navigate a delicate balance. Intervening to correct perceived injustices can distort the signaling process, creating unintended consequences. Mandating affirmative action policies, for example, can lead to accusations of reverse discrimination, undermining the perceived legitimacy of the signaling mechanism. The classical economist might argue that the market, left to its own devices, will eventually correct these inefficiencies, as firms that overlook talented individuals from disadvantaged backgrounds will ultimately lose out to their more astute competitors. Yet, can we afford to wait for the market to self-correct? The human cost of inaction is considerable. The policymaker must consider interventions that promote fairness without unduly disrupting the signaling process. These might include investments in education and job training programs, initiatives to combat algorithmic bias, and efforts to promote transparency in hiring practices. The challenge lies in finding the right balance, in ensuring that the signaling and screening mechanisms serve as pathways to opportunity, rather than as instruments of exclusion. As we conclude, we are left with a persistent question. How do we reconcile the efficiency of signaling and screening with the imperative of fairness? Can we design institutions that extract information effectively, while simultaneously mitigating the risk of bias and discrimination? This conundrum will, undoubtedly, continue to occupy our thoughts as we move into our next exploration of behavioral economics, and the subtle ways our minds distort decision-making within these economic systems. Chapter 38. The Impact of Information Asymmetry on Inequality. Access to opportunities. Last time, we considered how information asymmetry can skew market outcomes, creating imbalances in pricing and resource allocation. Now, we turn our attention to how these informational gaps exacerbate inequality by affecting access to crucial opportunities. At the heart of this lies the concept of signaling and screening. Think of a river, its current representing the flow of economic opportunity. Some areas along the riverbank have naturally deeper channels, offering easier access to the current. Others are shallow, requiring more effort and investment to reach the same flow. Information asymmetry creates artificial obstructions, damming up access for some while leaving others unimpeded. Signaling and screening represent the tools used to navigate these obstructions. Signaling is the act of conveying information about oneself to others, particularly when that information is not readily observable. It's like raising a flag to indicate your presence, your abilities, and your worth. Education, for instance, is a prime example of a signal. A university degree doesn't necessarily impart all the specific skills needed for a particular job, but it does signal a certain level of intelligence, discipline, and ability to learn. The individual invests time, money, and effort to obtain the degree, demonstrating their commitment and potential. This investment acts as a credible signal to potential employers. However, the effectiveness of education as a signal is influenced by its accessibility. If quality education is disproportionately available to those from privileged backgrounds, it creates a self-reinforcing cycle. Those already advantaged have an easier time obtaining the signal, further solidifying their access to better opportunities. This, in turn, limits the mobility of those from less privileged backgrounds, perpetuating inequality. The river's channels remain unevenly distributed, navigable only to a select few. Consider also the role of warranties. In a world of perfect information, everyone would know the exact quality of a product before purchasing it. But reality is far different. Warranties serve as a signal from the producer, indicating their confidence in the product's durability and performance. A longer warranty suggests higher quality, reducing the buyer's risk and encouraging them to purchase the product. This creates a market for higher quality goods, even when buyers cannot directly assess quality beforehand. However, if access to reliable warranties is limited, or if the cost of obtaining them is prohibitive for lower-income individuals, they may be forced to purchase lower-quality goods that are more likely to fail, ultimately impacting their financial well-being. The safety net, meant to catch them, is riddled with holes. The job market is perhaps the most complex arena for signaling and screening. Employers, lacking perfect information about potential employees, rely on various signals to assess their suitability. Resumes, interviews, and even social media profiles become channels for conveying information. Internships, volunteer work, and extracurricular activities are all valuable signals, demonstrating a range of skills and attributes beyond academic qualifications. However, access to these opportunities is often unevenly distributed. Individuals from disadvantaged backgrounds may lack the resources or networks necessary to obtain valuable internships or engage in impactful extracurricular activities, limiting their ability to effectively signal their potential to employers. The gatekeepers, unknowingly or otherwise, perpetuate the cycle. Screening, on the other hand, is the process by which those with imperfect information, like employers or insurers, try to extract information from others. They design mechanisms to sort individuals into different risk categories or skill levels. Job interviews, aptitude tests, and background checks are all forms of screening. While these tools are designed to improve decision-making, they can also unintentionally discriminate against certain groups. Standardized tests, for example, may inadvertently reflect cultural biases or fail to accurately assess the skills and knowledge of individuals from diverse backgrounds. The sieve, intended to refine, sometimes cracks. The policymaker faces a difficult challenge: how to level the playing field and ensure that everyone has a fair opportunity to access the economic river. Policies aimed at improving access to quality education, expanding internship opportunities, and reducing bias in hiring practices are crucial steps. But simply removing the obvious obstructions is not enough. We must also address the underlying currents that perpetuate inequality, the systemic biases and structural barriers that limit opportunities for certain groups. The task involves not just removing the dams, but also reshaping the riverbed itself. The classical economist might argue that these interventions distort the market and lead to inefficiencies. They might suggest that the market will eventually correct itself as employers recognize the untapped potential of overlooked individuals. However, waiting for the market to self-correct can be a long and painful process, particularly for those who are currently denied access to opportunities. The free flow of the river, unobstructed, is still dependent on the quality of its source. Ultimately, the impact of information asymmetry on inequality is a complex and multifaceted issue. It requires a nuanced understanding of how signaling and screening mechanisms operate, and a commitment to creating a more equitable and inclusive economic system. As we refine our understanding, a new question arises: how can we design better screening mechanisms that accurately assess potential without perpetuating existing inequalities? What new tools can we forge to measure true potential? Chapter 39. The importance of transparency and disclosure. Reducing uncertainty. The economic landscape, much like a vast ocean, is often obscured by fog. Participants lack perfect knowledge about the qualities and intentions of others. This asymmetry creates a fundamental problem. How can a seller convincingly communicate the superior quality of their product, or a worker their exceptional skills, to a skeptical buyer or employer? The answer lies in credible signals and effective screening processes. Signaling, in essence, is an attempt to voluntarily reveal hidden information. It involves actions that are costly or difficult to imitate, making them a reliable indicator of underlying quality. Consider education. Attending university and earning a degree involves significant investment of time, money, and effort. This investment acts as a signal to potential employers. The educated individual demonstrates not only acquired knowledge, but also perseverance, discipline, and the ability to learn. The signal works because it is more costly for less capable individuals to mimic. A low-skilled worker would find it far more difficult to complete a rigorous academic program. Warranties operate on a similar principle. A manufacturer offering a comprehensive warranty is signaling confidence in the durability and reliability of their product. They are essentially betting against future defects. This signal is credible because a manufacturer of a low-quality product would be financially burdened by frequent warranty claims. The risk of significant financial losses incentivizes them to produce goods that are less likely to fail, thereby justifying the warranty. The warranty becomes a badge of honor, a visible and quantifiable commitment to quality. Job markets also rely heavily on signaling. Resumes, interviews, and even dress codes serve as signals. Candidates strive to present themselves in a way that conveys competence, professionalism, and suitability for the role. These signals, while often nuanced and subjective, can influence hiring decisions significantly. Employers recognize that simply claiming to be a hard worker is insufficient. They seek verifiable evidence, whether it be previous job experience, demonstrated skills, or strong letters of recommendation. However, signaling is not a perfect solution. It can be costly and inefficient. Education, for example, may be partly about signaling and partly about acquiring skills directly useful in the workforce. Some critics argue that the signaling component inflates the value placed on formal education, diverting resources from other, potentially more productive, avenues. The signal becomes, in some cases, more important than the underlying skill. Screening, the counterpart to signaling, involves designing mechanisms to elicit information from others. It is the process by which an informed party, such as an employer or insurer, attempts to uncover the hidden characteristics of an uninformed party, such as a job applicant or a customer. The insurance company, for example, uses questionnaires and medical exams to assess the risk profile of potential policyholders. By collecting detailed information about their health and lifestyle, they can better predict their likelihood of filing a claim and adjust premiums accordingly. In the job market, employers use interviews and aptitude tests to screen candidates. They are attempting to identify the individuals who possess the skills, aptitude, and personality traits that best align with the demands of the role. The goal is to differentiate between candidates who may present similar signals, such as educational qualifications, but possess fundamentally different levels of capability. The effective interviewer understands how to pose questions that reveal not only what a candidate knows, but also how they think and solve problems. The classical economist understood the role of transparency in fostering efficient markets. Markets function most effectively when information flows freely and participants have access to reliable data. The policymaker, recognizing this, often implements regulations designed to promote transparency and disclosure, requiring companies to report financial information, disclose product ingredients, and provide accurate labeling. Transparency and disclosure are not merely ethical considerations. They are essential for economic efficiency. By reducing uncertainty, they enable more informed decision-making, facilitating smoother transactions and more optimal resource allocation. The flow of reliable information is the lifeblood of a healthy economy. It allows capital to flow to its most productive uses, encourages innovation, and protects consumers from exploitation. The delicate balance of the system depends on it. But what happens when the signals themselves become manipulated? When the game of information becomes less about truth and more about perception? We are left to ponder the implications of these distortions as we move forward. What is the consequence when the signal no longer accurately reflects reality? Chapter 40. The Future of Work. Automation, AI, and the skills gap. We've considered the swirling currents of technological advancement and the ways they reshape markets. Now, let us turn our attention to the human element within this transformation, specifically the economic theories of signaling and screening, and how they illuminate the interplay between education, perceived skills, and the future of work in an age of automation and artificial intelligence. Imagine, if you will, a flowing river. On one bank reside potential employees, each possessing a unique constellation of skills and aptitudes. On the other bank sit employers, seeking to fill specific roles with individuals who can contribute effectively to their organization's goals. The challenge, of course, is that employers rarely possess perfect information about the capabilities of these potential employees. They need a method to discern the genuine article from the mere appearance of competence. This is where the concepts of signaling and screening become crucial. Signaling, in essence, is the process by which an individual attempts to convey information about their abilities to a potential employer. Education, for example, serves as a powerful signal. Earning a degree, particularly from a reputable institution, can signal not only acquired knowledge, but also conscientiousness, perseverance, and the ability to learn new skills. The diploma itself is not inherently productive. It does not magically imbue the graduate with specific job skills. Instead, it signals that the individual likely possesses attributes valuable to an employer. Similarly, certifications and professional licenses act as signals, demonstrating proficiency in specific areas. Think of a software engineer who earns certifications in particular programming languages or cloud computing platforms. These certifications signal to potential employers that the individual possesses a validated level of competence in those domains. They cut through the ambiguity of the market, providing a tangible representation of skills. Warranties, in the context of goods and services, function similarly. A company that offers a generous warranty on its products is signaling confidence in their quality and reliability. They are betting that the cost of potential repairs or replacements will be outweighed by the increased sales and customer loyalty that the warranty generates. Screening, on the other hand, is the process by which employers attempt to gather information about potential employees. This can take many forms, from reviewing resumes and conducting interviews to administering skills assessments and personality tests. Employers are, in essence, trying to sift through the signals being presented to find the individuals who truly possess the skills and attributes they require. The challenge, however, lies in the imperfection of both signaling and screening. Signals can be noisy. A degree from a prestigious university might not guarantee competence, and certifications can be obtained through rote memorization rather than genuine understanding. Similarly, screening processes can be biased or ineffective, leading employers to misjudge the capabilities of potential employees. Now, consider the implications of automation and AI on these established systems. As technology advances, the demand for certain skills is likely to decline, while the demand for others will increase. The skills gap, the mismatch between the skills that employers need and the skills that workers possess, is widening. This puts enormous pressure on both individuals and institutions to adapt. Furthermore, the nature of work itself is changing. The rise of the gig economy and remote work has altered the traditional employer-employee relationship, making it more difficult for employers to screen potential workers. At the same time, individuals are increasingly responsible for signaling their own value in a competitive marketplace. What then is the future of signaling and screening in an age of AI-driven automation? One possibility is a greater emphasis on lifelong learning and skills development. Individuals will need to continuously update their skills to remain relevant in a rapidly changing job market. This could lead to the rise of new forms of signaling, such as micro-credentials or digital badges, which can demonstrate specific skills and competencies more effectively than traditional degrees. Another possibility is the development of more sophisticated screening tools, powered by AI, that can better assess the capabilities of potential employees. The policymaker needs to carefully consider the long-term impact on human capital. However, these technological solutions also raise important questions about equity and access. Will everyone have equal opportunity to acquire the skills and signals that are valued in the future job market? Will screening tools be free from bias, or will they perpetuate existing inequalities? The classical economist would argue that market forces will drive efficient allocation, but historical evidence shows intervention is required to prevent deepening inequalities. The delicate balance of signaling and screening, forever shifting under the weight of technological advancement. Perhaps our next exploration should delve into the ethical considerations surrounding the implementation of AI in the labor market. How do we ensure fairness and opportunity in a world where algorithms are increasingly making decisions about who gets hired and who gets left behind? Case Study 1. The market for used cars. We've discussed the theoretical underpinnings of signaling and screening. Now, let's ground these concepts in a tangible reality. Our bridge from abstract theory to practical application is paved with a classic example: the market for used cars. This isn't merely about buying a vehicle. It's a microcosm of information asymmetry, a stage where signals and screens perform their intricate dance. Imagine, if you will, a world populated only by used vehicles. Some of these cars are peaches, mechanically sound, reliable, and well-maintained. Others are lemons, plagued by hidden defects, destined for costly repairs and a generally frustrating existence. The crucial point: sellers naturally know the true quality of their cars. Buyers, on the other hand, can only guess. This information disparity, this knowledge imbalance, is the root of our economic predicament. The buyer, facing this uncertainty, is willing to pay only the average price for a used car. They reason, quite rationally, that since they can't distinguish between a peach and a lemon, they must assume the car is somewhere in the middle. However, this average price creates a devastating consequence for the sellers of peaches. Knowing their cars are actually above average in quality, they are unwilling to accept the average price. Why would they sell a valuable asset for less than its true worth? This is where we encounter adverse selection. The peaches, the good cars, gradually disappear from the market. Only the lemons remain, dragging down the average quality, and therefore the average price, even further. This self-perpetuating cycle can ultimately lead to the collapse of the market, a situation where only the worst cars are traded, and many potential gains from trade are left unrealized. It's a system thrown out of balance, a flow disrupted by the friction of imperfect information. How then can we restore equilibrium? How can we coax the peaches back into the market and facilitate mutually beneficial transactions? This is where signaling and screening enter the picture as potential remedies. Consider warranties. A seller who offers a comprehensive warranty is, in effect, signaling the quality of their car. They are betting their own money that the car will not break down, a credible commitment that only a seller of a peach would be willing to make. A warranty acts as a signal because it's costly for the seller of a lemon. They risk incurring significant repair costs. The buyer, observing this warranty, can then infer that the car is likely of higher quality. Another mechanism involves third-party inspections. An independent mechanic can screen the car, providing a report to the buyer that reveals the car's true condition. This screening reduces the information asymmetry, allowing buyers to make more informed decisions and be willing to pay a price that more accurately reflects the car's quality. The mechanic, acting as an unbiased evaluator, helps to level the playing field. This used car market analogy extends far beyond automobiles. Think of the labor market. Employers face a similar problem: how to identify the most productive workers. Education, in this context, becomes a signal. Candidate with a degree signals that they possess certain skills and abilities, even if the degree itself doesn't directly translate to job performance. The effort required to obtain the degree acts as the signal, separating those willing to invest in their human capital from those who are not. Employers therefore use education as a screening device, filtering applicants based on this readily observable characteristic. Similarly, job experience serves as a signal. A proven track record of success demonstrates competence and reliability. Internships, probationary periods, and reference checks all act as screening mechanisms, allowing employers to assess the true potential of a candidate before making a long-term commitment. These examples illustrate the pervasive nature of signaling and screening in our economic lives. They are tools we use to navigate a world of imperfect information, to bridge the gap between what we know and what we wish to know. They are imperfect, certainly, but often necessary for a functional and efficient economy. As we consider these imperfect solutions, we might ask ourselves, how effective are these signals and screens in practice? Do they truly alleviate the problem of information asymmetry, or do they merely create new forms of distortion? And what are the ethical implications of using these mechanisms, particularly when they perpetuate existing inequalities? These questions, like the gentle ebb and flow of the tide, guide us towards our next exploration: the nuances of behavioral economics. 1. Case Study 2. The healthcare industry. We've discussed the theoretical framework of signaling and screening, the intricate dance where individuals with superior information attempt to convey their value, and institutions strive to identify them. Now, let us gently turn our attention to a specific arena where these principles manifest perhaps more visibly, and arguably more consequentially than in many others: the healthcare industry. Consider the physician. Medical school, residency, board certifications. These aren't simply boxes to be checked, they are costly signals. The time investment alone represents a significant commitment, a sacrifice of potential earnings in other fields. The rigorous curriculum, the brutal hours, the emotional toll, all serve to winnow the field, leaving behind those with not just the intellectual capacity, but also the resilience, dedication, and perhaps crucially, the empathy required to effectively practice medicine. These attributes are difficult to observe directly, making the formalized education process a valuable, albeit imperfect, signal to prospective patients and employers. Furthermore, the cost of malpractice insurance functions as a type of screening mechanism. While ostensibly designed to protect patients, it also subtly differentiates practitioners. A physician with a history of malpractice claims, or who practices in a high-risk specialty, will face significantly higher premiums. This additional cost might deter less capable or less cautious individuals from pursuing certain paths within the profession. The insurance market, in effect, acts as a sieve, separating those deemed by actuarial science to be higher risk from those perceived as lower risk. Now the question arises, how effective are these signals and screens? The classical economist might argue that the market, left to its own devices, would eventually sort things out. Physicians who consistently provide subpar care would, through word of mouth and perhaps legal action, lose patients and professional standing. This natural selection, akin to a biological ecosystem finding equilibrium, would ultimately weed out the less competent. However, the reality is far more complex. Information asymmetry abounds. Patients often lack the expertise to accurately assess the quality of medical care they receive. Moreover, emotional distress and vulnerability can cloud judgment, making individuals more susceptible to persuasive rather than demonstrably superior offerings. The very nature of illness creates a power dynamic that can be easily exploited. This is where screening mechanisms like hospital affiliations and institutional reputations become important. A teaching hospital, for example, generally attracts physicians committed to ongoing learning and rigorous peer review. The hospital's brand, built over decades of research and patient care, acts as a signal of quality, attracting both patients and talented medical professionals. The policymaker might then introduce regulations, such as mandatory continuing education requirements or standardized quality reporting metrics, to further mitigate information asymmetry and ensure a baseline level of competence across the board. However, these interventions also carry potential drawbacks. Excessive regulation can stifle innovation and limit access to care, particularly in underserved communities. Stringent certification requirements might disproportionately affect practitioners from diverse backgrounds, perpetuating existing inequality. The ideal solution lies in finding a delicate balance, fostering transparency and accountability without unduly burdening the healthcare system. Consider the role of warranties in this context. While a direct warranty on medical procedures is uncommon, the concept of satisfaction guarantees is gaining traction in certain areas, such as elective cosmetic surgery. A clinic might offer a revision procedure at a reduced cost if the initial outcome falls short of expectations. This signals confidence in their skills and provides patients with a degree of recourse, mitigating the inherent uncertainty surrounding medical interventions. However, such guarantees must be carefully structured to avoid incentivizing unnecessary procedures or creating unrealistic expectations. Ultimately, the healthcare industry presents a fascinating case study in the economics of signaling and screening. The stakes are high, the information asymmetries are pervasive, and the solutions are often imperfect. We've touched upon several key elements: costly signals like education, screening mechanisms like insurance, and reputational safeguards. But as we stand at this crossroads, pondering the health and vitality of our economic systems, a question lingers. In an era of rapidly advancing technology and increasingly personalized medicine, how will these signaling and screening mechanisms adapt to ensure equitable access to high-quality healthcare for all? Chapter 43. Case Study 3. The venture capital market tonight. We'll explore how the principles of signaling and screening, so crucial to understanding education, warranties, and job placements, manifest themselves in the high-stakes world of venture capital. Imagine, if you will, a flowing river of capital, seeking to nourish the seeds of nascent businesses. The venture capitalists, those seasoned navigators of this river, are constantly trying to distinguish promising tributaries from stagnant pools. They seek the next transformative innovation, the company that will disrupt markets and generate significant returns. But this search is fraught with information asymmetry. The entrepreneur, brimming with enthusiasm and armed with a business plan, knows far more about the true potential of their venture than the venture capitalist ever can. This informational imbalance creates fertile ground for the dynamics of signaling and screening to take root. D. The entrepreneur must signal the quality of their idea their team, and their commitment. The venture capitalist, in turn, must screen these signals, separating the wheat from the chaff, the genuine innovation from the fleeting trend. Let us consider the signaling aspect first. How can an entrepreneur, often lacking a proven track record, effectively communicate the value of their venture? One potent signal is a substantial personal investment. By committing their own capital, the entrepreneur signals their belief in the venture's success. This act of putting skin in the game reduces the perception of moral hazard. It demonstrates that the entrepreneur is not simply seeking a payout, but is genuinely invested in the long-term growth of the company. A classical economist would view this as a classic example of aligning incentives to overcome information problems. Another critical signal is the quality of the founding team. Experienced entrepreneurs with a history of successful ventures carry significant signaling power. Their past achievements serve as a testament to their skills, knowledge, and ability to navigate the complex landscape of the business world. The presence of advisors or board members with strong reputations in the relevant industry also acts as a valuable signal. These individuals lend credibility to the venture and demonstrate that the entrepreneur has successfully attracted experienced guidance. Think of it like a well-balanced ecosystem. Each element strengthens the others. Now, let's turn our attention to the screening process employed by venture capitalists. Screening, in essence, is the process of gathering and analyzing information to assess the true value of a potential investment. Venture capitalists use a variety of tools and techniques to screen ventures, ranging from due diligence investigations to competitive landscape analyses. They scrutinize the business plan, interview the management team, and conduct market research to evaluate the potential for growth and profitability. One important screening mechanism is the use of staged financing. Rather than providing the entire investment up front, venture capitalists often structure deals with tranches of funding tied to specific milestones. This allows them to monitor the venture's progress and assess its ability to execute on its business plan. If the venture fails to meet its milestones, the venture capitalist can choose not to release the next tranche of funding, limiting their potential losses. This phased approach allows for continuous evaluation and reduces the risk associated with investing in early-stage companies. A policymaker would see this as a mechanism for efficient resource allocation. Another screening technique involves seeking validation from independent sources. Venture capitalists may consult with industry experts, conduct customer surveys, or review patent filings to gather additional information about the venture. These external assessments help to reduce the risk of relying solely on the information provided by the entrepreneur. The key here is to build a comprehensive and well-informed picture before committing substantial capital. The interplay between signaling and screening in the venture capital market is a dynamic and evolving process. Entrepreneurs constantly seek new ways to signal the quality of their ventures, while venture capitalists refine their screening techniques to identify the most promising opportunities. The efficient allocation of capital in this market depends on the effectiveness of these mechanisms. Policy implications. Designing effective regulations. We've explored the intricate dance of information asymmetry, where some participants hold knowledge others lack. Now, let's consider the policy implications of signaling and screening, particularly as they manifest in education, warranties, and job markets. The insights gleaned here guide us towards designing regulations that promote efficiency and fairness in these vital sectors. The essence of signaling, recall, is the attempt to convey information credibly. Individuals or firms possess private information, say, the inherent ability of a potential employee or the quality of a newly manufactured product. The challenge lies in revealing this information to those who need it, the employers or consumers, in a way that cannot easily be faked. Education, often hailed as a great equalizer, functions significantly as a signal. The years spent in classrooms, the degrees earned, the accolades received. These aren't simply measures of acquired knowledge. They are signals to prospective employers, indicating perseverance, intellectual capacity, and the ability to learn and adapt. However, the signal's value is contingent on its credibility. Policy interventions should focus on maintaining the rigor and standards of educational institutions. Grade inflation, for example, dilutes the signal, muddying the waters for employers and diminishing the value of legitimate academic achievement. Accreditation agencies play a critical role here, serving as gatekeepers against the erosion of educational standards. Regulations demanding transparency in curriculum and assessment methods can further strengthen the signal's reliability. Warranties, a familiar feature of consumer markets, provide another compelling example of signaling. A firm offering a generous warranty is essentially signaling confidence in the durability and performance of its product. A short warranty, conversely, might suggest underlying doubts. But again, information asymmetry arises. The consumer might misuse the product, leading to premature failure, or they might lack the expertise to properly assess its quality beforehand. Policy can step in to ensure warranty terms are clear, comprehensive, and enforceable. Standardized warranty language, for instance, could reduce ambiguity and prevent firms from exploiting loopholes. Consumer protection laws that mandate minimum warranty periods for certain product categories can also address the information imbalance, pushing firms to internalize the potential costs of low-quality production. The job market, perhaps more than any other, is fertile ground for signaling and screening dynamics. Employers strive to identify the most productive candidates, but they rarely have complete information about their true abilities. Resumes, interviews, and reference checks serve as screening devices, allowing employers to filter out less suitable applicants. Educational credentials, as we've discussed, act as signals. But regulations aimed at promoting fairness and equal opportunity must tread carefully. While it's tempting to mandate blind resume reviews or ban questions about salary history to reduce bias, these measures can inadvertently stifle the flow of information. Employers may resort to alternative, less transparent screening methods, potentially exacerbating existing inequalities. The key lies in fostering transparency in the hiring process, encouraging the use of standardized assessments, and providing support for individuals from disadvantaged backgrounds to acquire the skills and credentials that signal their capability. Screening, the complementary action to signaling, involves designing mechanisms to elicit information from those who possess it. Consider the design of insurance contracts. Insurance companies face the challenge of adverse selection. Those most likely to file claims are also most likely to purchase insurance. To mitigate this, insurers employ various screening techniques, deductibles, co-payments, and questionnaires designed to assess risk profile. Regulations can play a role in ensuring these screening practices are fair and non-discriminatory, preventing insurers from unfairly denying coverage based on protected characteristics. Furthermore, regulations can promote transparency in pricing, enabling consumers to compare policies and make informed decisions. The challenge for the policymaker, then, is to walk a tightrope. Overly intrusive regulations can stifle innovation and efficiency, hindering the very signals and screens that facilitate transactions. Under-regulation, conversely, can lead to market failures, exploitation, and a loss of trust. The ideal approach is to craft regulations that promote transparency, standardize information, and protect vulnerable parties, while allowing market forces to operate freely. The aim is not to eliminate information asymmetry entirely, but to level the playing field and ensure that signals and screens convey reliable information, leading to more efficient and equitable outcomes. The classical economist might argue for minimal intervention, trusting that market forces will eventually sort things out. However, the persistence of information asymmetries and the potential for exploitation they create often necessitates a more active role for the policymaker. The design of effective regulations is an iterative process, requiring careful monitoring, evaluation, and adaptation. As economic landscapes evolve, so too must the regulatory framework. This brings us to a final lingering question. How do behavioral biases influence the effectiveness of signaling and screening mechanisms? Do individuals consistently act rationally in their attempts to signal their abilities or screen potential partners? We will need to peer into the realm of behavioral economics to fully grapple with this question. Chapter 45. Conclusion. Signaling, screening, and the future of markets. We've journeyed through a landscape of imperfect information, a realm where asymmetries reign and decisions are fraught with uncertainty. Building upon our exploration of moral hazard and adverse selection, We now arrive at the final vantage point. The intricate dance of signaling and screening, vital mechanisms for navigating the murky waters of information gaps in markets, particularly within education, warranties, and the crucial domain of job markets. The essence of signaling lies in the proactive disclosure. Imagine a peacock, its magnificent plumage a costly display. It's not just about beauty, it's about communicating something deeper, something vital about the peacock's genetic fitness, its resilience. In markets, similar displays occur. Education, for instance, can be viewed less as the accumulation of specific skills and more as a signal of diligence, intelligence, and the ability to persevere through challenges. The sheepskin, the diploma, becomes a shorthand, a readily observable indicator for potential employers grappling with incomplete knowledge about a candidate's true capabilities. The classical economist, observing this, might say, the market, through the pursuit of higher education, seeks to allocate resources efficiently, guiding those with inherent potential towards opportunities where that potential can be realized. But signaling isn't a unilateral act. It requires an audience, a receiver capable of interpreting the signal. This is where screening enters the picture. Screening is the art of extracting information, of designing mechanisms that compel individuals to reveal their hidden characteristics. Think of a car warranty. A manufacturer offering a comprehensive warranty on a new vehicle signals confidence in its product's reliability. But, from the consumer's perspective, the warranty acts as a screening device. Those who anticipate needing frequent repairs, perhaps due to aggressive driving habits or a disregard for maintenance, might value the warranty more highly, revealing indirectly information about their expected behavior. In the context of job markets, the interplay of signaling and screening becomes particularly nuanced. A job applicant, armed with a meticulously crafted resume and a carefully rehearsed interview, attempts to signal their suitability for the role. The employer, in turn, employs various screening techniques, aptitude tests, personality assessments, background checks, all designed to filter out those who might misrepresent their capabilities. The policymaker, concerned with fostering fair and efficient labor markets, must grapple with the potential for these mechanisms to be either inclusive or exclusionary. Over-reliance on specific credentials, for instance, could inadvertently disadvantage qualified individuals from non-traditional backgrounds, hindering social mobility and perpetuating inequalities. The system must find a delicate balance, allowing signals to be informative without creating insurmountable barriers. Consider the evolution of online marketplaces. Early platforms grappled with profound information asymmetries. Sellers might exaggerate the quality of their goods, while buyers might engage in opportunistic behavior after a purchase. The introduction of reputation systems, star ratings, reviews, feedback mechanisms, transformed these markets by enabling both signaling and screening. Sellers, incentivized to maintain positive ratings, signal their commitment to quality and customer service. Buyers, armed with this collective intelligence, can more effectively screen out unreliable sellers. This illustrates the power of carefully designed institutions to mitigate the problems arising from information gaps. Yet, even the most sophisticated signaling and screening mechanisms are imperfect. They can be costly, distort market outcomes, and in some cases, be manipulated to create false impressions. The pursuit of excessive certifications in some professions, for example, can become a form of rent-seeking, diverting resources away from productive activities and raising barriers to entry. Similarly, overly complex screening processes in hiring can lead to biased outcomes, reinforcing existing social inequalities. The challenge, then, is not to eliminate information asymmetries entirely, an impossible task, but to design markets that are resilient in the face of them, markets that promote transparency, incentivize truthful communication, and reward those who invest in building credible signals. As we conclude this exploration, it's evident that the ongoing evolution of information technology will continue to reshape the landscape of signaling and screening. The rise of big data and artificial intelligence offers both opportunities and challenges. Can we harness these tools to create more efficient and equitable markets, or will they exacerbate existing inequalities by amplifying biases and creating new forms of information asymmetry? This is a question that will undoubtedly dominate the economic discourse in the years to come. A question that beckons us to consider, with careful contemplation, the shape of the future of markets. What new forms of signaling and screening will emerge in this data-rich world? And how will we ensure that they serve the collective good?